politics to the world of business. This is Balance of Power. Live from Washington, D.C.
President Biden wraps the G7 in Italy as the world watches developments in both Ukraine and Israel. I'm Joe Matthew alongside Kaylee Lyons, live in Washington, here on Balance of Power on Bloomberg TV and radio. And Kaylee, the White House is already trying to spin this as a successful trip. He'll be back home tomorrow.
Of course, there are a few deliverables that actually are tangible outcomes of this trip. The decision among G7 countries to use $50 billion in frozen Russian assets to fund Ukraine, and as well a 10-year security pact that the U.S. and Ukraine and, well, the presidents of those countries signed yesterday. So certainly we had a lot in regard to Ukraine delivered on this agenda, but we know there were other topics of conversation as well, including China.
Yes, indeed. And
China and the threat it poses is something we also talked about earlier today with Taiwan's representative to the U.S., and we'll have some of that conversation this hour.
Yeah, we have a couple of special conversations ahead for you on this hour of Balance of Power here on Bloomberg. Not only the representative from Taiwan, but Michael McKee's interview with the Cleveland Fed President Loretta Mester will be coming up just about 15 minutes from now, Kaylee.
And we'll speak with Congresswoman Dina Titus of Nevada. Her district is in Las Vegas, where 60 people in 2017 were killed in the largest mass shooting in history, a shooter that was using bump stocks, and the bump stock ban today overturned by the Supreme Court. So we'll have a lot coming up this hour. First, though, as always, let's get a check on the markets with Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much, Kaylee and Joe. We have got the Dow, the S&P, NASDAQ all trading in the week, but to be sure, we do have the S&P on track for another winning week right now on the week. The S&P is up by about 1.4%. Right to the numbers, a renewed wave of volatility gripping global markets. Here in the U.S., we got the S&P down 10 right now, 54.23, drop now of 0.2%. The Dow down 70 points, also down roughly 0.2%, while NASDAQ, the composite index, down 21 now, a decline of 0.1%. But interestingly, the NASDAQ 100 index, full of big tech names, up by about 0.2%. 10-year at 4.22%, with a 2-year that's now yielding 4.68%. Spot gold surging $24 the ounce, flight to safety up 1.1%, 23.28 on the precious metal, and West Texas Intermediate crude below $79 a barrel now, 78.72, up by about 0.1%. Big day for Adobe shares. They're up 14.5%, biggest gain in about 4 years after projecting strong future sales for its creative products. A lot of news involving Apple today, but bottom line, the stock is on track for its best week since 2021 on a bet that AI iPhones will be must-haves. Right now, we've got Apple lower by 1%. So again, recapping here, stocks lower, S&P down now by 10 points, a decline of just about 0.2%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at how we're wrapping up the week on Wall Street. Thank you so much. And what a week it has been, Joe. It was this week that we got the conviction of the president's son, Hunter Biden, Donald Trump visiting both chambers of Congress, or at least Republicans in them, meeting with business executives, and Joe Biden in Italy at the G7, where a lot of news came out from. It's been a busy one. TGIF.
It's been wild, yes, and to you as well. Thank you. Yeah, any of these would be lead stories that could last the better part of a week unless they were all jammed together. And we certainly have experienced a lot together here, a lot of history this week on Balance of Power, and we're actually not done yet. Joe Biden set to wrap things up at the G7, and that's why we want to bring in Bloomberg's Anne-Marie Hordern, who is live in Bari, Italy, for the final throes of this summit. Anne-Marie, how is Joe Biden wrapping things up today?
Well, we're waiting for this family photo, and then he's going to have a bilateral, more of a personal meeting with the Pope. The Pope was here, the first pontiff to ever address G7 leaders, and really gave a speech about the importance that the Pope sees of artificial intelligence and the potential dangers of that. But for this president, and for a lot of these leaders who came in dealing with a lot of serious domestic issues at home, for the U.S., they're walking away with two big wins. One, of course, is being able to get over the finish line, that $50 billion worth of loans going to Ukraine, tapping the Russian assets, $280 billion worth, that are currently immobilized right now in Europe, and also signing this long-term security agreement with Ukraine. And Biden spoke extensively about that yesterday. And then from here, he's going to be heading off to Los Angeles, back to the United States, for a campaign fundraiser in California with the likes of George Clooney, Jimmy Kimmel, and some other celebrities. He's not going to be going where other G7 leaders are going, or some of them are going, which is a Ukraine peace forum in Switzerland. He did receive some criticism about that, but he spent a lot of time here on the ground in Italy with President Volodymyr Zelensky, who is very happy to get through that financing and, of course, being able to sign that security agreement.
Well, Anne-Marie, of course, you've been busy on the ground as well, speaking with a number of leaders, including earlier today, the president of the World Bank, Ajay Banga. What did he tell you?
What was interesting with Ajay Banga is he's able to get across the finish line with the private investors that were here, notably Larry Fink of BlackRock, $4 billion worth. They're able to unlock this private investment through some of the programs that the World Bank set up. So that was a win for him, and he really wants to focus on Africa, which is something the Italian Prime Minister has really wanted to focus on, and the United States. The United States, I think, sees it really as a place where they can counter China, where Giorgia Meloni sees it as a place where they can invest in food and energy and jobs to potentially quell some of the migration flows that are coming from the continent. But I also talked to him about this idea of nationalism rising, and we saw that at the European parliamentary elections over the weekend, and that was a huge blow for the likes of Macron and Schultz. Take a listen to what he had to say.
Not really. I remember that during his prior presidency, he was one of those who actually gave the capital increase to the World Bank. He sees the value of this leverage and the value of this kind of institution.
So when I asked him about potentially Trump president, Trump 2.0, he said that what Trump saw in his first term was a capital injection into the World Bank and the value of working in this multilateral way at the World Bank. So whether or not it's Biden or Trump coming in next, it looks like Mr. Banga is prepared for potentially that support from the United States to continue with the World Bank.
All right, Bloomberg's Anne-Marie Horadern in Bari, Italy. Thank you so much. Of course, when we're thinking about the difference between Biden and Trump, it's also worth pointing out how differently they were spending their time this week. President Biden in Italy with other leaders of the G7, Donald Trump here in Washington, crisscrossing town, and today celebrating his birthday. Let's bring in now our political panel, Jeannie Sheehan Zaino and Rick Davis, both Bloomberg Politics contributors. Jeannie now, of course, is a senior fellow at the, there's a long title here.
Yes, there is. We'll
and yet
get
it's
that
not.
for you.
Yeah, Jeannie has a new job. She also is a professor at Iona University, and Rick Davis, Republican strategist. We all know that well. Jeannie, when we consider the week that Joe Biden had in contrast to the week that Donald Trump had, Joe Biden, yes, was abroad, being able to seem presidential on a trip to the G7. And yet, how much do foreign policy wins, like the ones he was able to notch up in recent days, actually matter as he campaigns for re-election? Or is it more domestic wins, like getting all of the members of your party in Congress to cheer alongside you in Washington, D.C., that will ultimately matter?
I think for Joe Biden, he wants to distinguish himself from Donald Trump, and he was able to do that in a very concerted way on the trip to Normandy for D-Day, and of course at the G7 with these two big accomplishments that you were just talking with Anne-Marie about, the 50 billion loans to Ukraine and the long-time security agreement. So the White House and the campaign are very happy with those. Of course, he hasn't forgotten about the campaign. He's coming back here for a fundraiser. And they have also been making a good deal of President Trump, the campaign that is, some of his statements yesterday with Republicans. So they are moving along that line. Domestic policy always going to play bigger than foreign policy in an election like this. But he wants to look presidential, and he did in the last several weeks.
What do you think of the takeaways here, Rick? We're talking about $50 billion for Ukraine. That in itself could be called success for this administration, considering the debate we just went through domestically here in the U.S. Did he get enough done to make this worth it?
You know, I think that there's progress there. Obviously, like Jeannie said, anytime you can put this kind of money together, especially leveraging Russian assets, it's a good thing. kind of harkened back a little bit to Donald Trump, during the debate over the supplemental, saying, just give him a loan. And I know it's apples and oranges, but it is entertaining to find such an echo across the pond in this case. I would say, though, there is some brewing discontent. In addition to the G7, there's a secretaries meeting of NATO where the United States is under some, I think, worthy criticism for constantly moving the red line on what we're willing to do. There are still no F-16s flying the skies of Ukraine for Ukraine. There is continued debate over whether or not we can use our weapon systems that we've given them to attack Russian spots in Russia. And this is one of the things that the rest of Europe seems unified on, and we're the outlier. And we've been the outlier so many times, and then to cave. This administration has really sent mixed signals. So I think that there certainly are some wins, but I think there's some trouble on the horizon when it comes to being aligned with our NATO allies.
And obviously, the trouble on the horizon for NATO allies or other world leaders comes in part due to a question of uncertainty as to who is going to be leading the United States come January of 2025. And a lot that will factor into that outcome includes not just these foreign policy issues, but what's happening domestically as well, including the economy, which we know is a weak spot for President Biden. And Rick, I know you always love when the University of Michigan releases its consumer sentiment data. It wasn't looking good today. You have sentiment much lower than anticipated, inflation expectations much higher. That doesn't signal that things are getting better for the U.S. consumer or voter as we get closer to the election.
You're absolutely right. I wait on bated breath for those Michigan consumer sentiment indexes that came out this morning. And look, I mean, the estimate was supposed to be 72, and it came in at 65. This was a major disappointment for the administration and for anybody who thinks that the public is starting to see the economy improve. It's actually the opposite. And when you dig in, the data even gets worse and worse from a point of view of how people feel about inflation and how they feel like it's affecting their own personal financial situation. And I think all of this really has a resounding effect on politics. If you aren't happy with your personal financial situation, if you believe inflation is higher than it is, you believe the unemployment rate is stronger than it is on record, and if you don't think your future financial prospects are great, why in the world would you vote for a party in power? And I think this is the single biggest hurdle in the Biden administration. It's got nothing to do with demographics. It's all about the economy.
Well, what do you think, Jeannie? Because after that CPI report in the Fed meeting this week, maybe it's no wonder that Joe Biden is predicting interest rate cuts. How much do his election chances ride on that?
It rides an awful lot on the economy overall, inflation and cost in particular. I would say, obviously, the consumer numbers are not great, but we have seen better numbers on the economy for Joe Biden. We had a poll out of the Financial Times and the University of Michigan's Ross School of Business, which showed that people trusting him more on the economy, his numbers were much better in the month of June. So, but it remains a tough spot for him. But I would say they have done a better job in responding to this. And I would note when the CPI came out earlier this week, the first thing that the campaign in the White House said was costs are too high. And they also are starting to grasp what people don't like about Donald Trump, at least some of them, which is they think that Donald Trump is all out for himself and his rich friends. And they are starting to make that case. And of course, Trump's appearance before the Business Roundtable, when he's talking about lowering the corporate tax, not even holding it steady, but lowering it further. When people are worried, you look all over TikTok about the cost of everything. So Joe Biden's got to keep hammering. I am for you and people like you. He is for the wealthy billionaires like him. And of course, there was an ad out yesterday from the Democrats, which made this case. So, you know, they have a lot of work to do, but they're starting, I think, to grasp what the message should be if they could just get their surrogates on board and get out there and make it in a more concerted way.
Well, Jeannie, we know that Joe Biden next week is going to begin debate prep. It's less than 2 weeks from today, that first debate between him and Trump. Should he be telling voters in that debate that the economy is good or bad?
He should be telling them that it is getting better, but it's nowhere near where it needs to be, that costs are way too high. And guess what? If this guy gets in, meaning Donald Trump, he is going to lower taxes like he did last time for his billionaire friends. He doesn't care about you. He cares about himself. He's running to stay out of jail and to lower his own taxes. And he even said it to his oil billionaire friends, and he said it again to the CEOs. So that's the kind of case he's got to keep making. Not so much policy-based, but I'm for you, he's for him and them. That's got to be the message on the economy.
Well, great conversation, as always. Jeannie, thank you. Jeannie Shanzano, Bloomberg Politics contributor and senior democracy fellow at the Center for the Study of the Presidency and Congress. That is it. Yes, indeed. And, of course, Rick Davis, Bloomberg Politics contributor partner at Stone Court Capital. We thank you both, as always, for the insights and the analysis. They will be back with us on the late edition of Balance of Power. That's at 5 p.m. Washington time. I'm Joe Matthew alongside Kaylee Lyons in Washington. This is Balance of Power as we bring you a special conversation now. Thanks to our colleague Michael McKee, who's joining us from World Headquarters in New York, and a special conversation with Cleveland Federal Reserve Bank President Loretta Mester. Michael, take it away.
Well, thank you very much, and good afternoon to everybody watching us and listening to us on Bloomberg Television and radio around the world. And I don't know what you say to people on the internet who are watching, listening, whatever, but thank you very much for joining us. This is sort of your farewell tour. You're retiring at the end of the month. So let me ask you, you've been a voter this year to this point. By December, do you think we will see one rate cut, more rate cuts, or no rate cuts?
Well, thanks for inviting me to be here. I mean, we all put in our projections at this meeting that was held this week, and the median projection in the SEP is pretty close to my own projection for the economy. We've made pretty good progress on inflation over the last 2 years. It's still too high. The most recent data that we received, in fact, we got the CPI report on the second day of the meeting, and it was a great gift for my last FOMC meeting to get that report, the good news there. But it still means that there's work to do on inflation to gain confidence that it is on that downward trajectory to 2%. And you know, the unemployment rate has ticked up a little bit over the last couple of months. Certainly, though, if you look overall, the labor market conditions remain healthy, and that's a great thing too. So I think monetary policy right now is well positioned really to ensure that inflation does move back down towards 2% over time, and that labor market conditions remain healthy. And that's a good position to be in. And if you look at the SEPs overall, what you see is the modal path of the SEP across participants is that rates will be coming down. The dot plot shows that there was weight on 1, 0, 2, but it'll really depend on how the economy actually evolves. And I think that's going to be the work of the committee going forward, assess incoming information about the economy. Does it change your outlook? Is it consistent with the modal outlook? And as inflation comes down and as inflation expectations short run, a year ahead, comes down, then it'll be appropriate to reduce that Fed funds rate and remove some of the restrictiveness.
Well, further confidence that you're moving towards the 2% target is almost a cliche now. What does that actually mean? Does it mean you need to see the various inflation indicators keep coming down, even if it's only, say, a tenth? Do you have a level of the year-over-year rate of inflation that you want to hit? How can people judge what the Fed is going to do, what they're thinking about?
So what my view would be is I'd like to see a few more months of inflation reports that are positive in the sense of similar to what we got last month. I'd like to see that continue. Remember, at the beginning of the year, January inflation was higher. There was some real issues with measurement, residual seasonality in that measure. But then we got 2 more reports that were consistent with, wow, there's not been progress this year. I came into the year not expecting the same degree of progress that we saw over the second half of last year, because we did get a lot of help from the improvement in supply conditions, both in the labor market and in product markets, and I didn't expect that to continue. And a lot of the work that the Cleveland Fed does in our Center for Inflation Research suggests that it's going to take some time to get inflation back to 2% all the way back. So my projection is that we probably won't get there until 2026, but we'll see progress continue in my modal view. And that's enough, right, to then say, okay, it's time to start the process of bringing rates down and normalizing our policy.
So as long as it moves down, it doesn't have to hit a point target.
Yeah, not to me. To my view would be that if I continue to see some of these better inflation reports that we got than we got earlier in the year, if that continues, then I'd feel comfortable starting that process of normalizing rates.
Well, you've said what others have said on the Fed, that once the momentum is there, it'll keep going down, so you don't want to wait till you get to 2,
Correct.
So you don't fall below it. But by implication, that means you're going to be starting behind the curve. Inflation will already be heading in that direction. Can you put the brakes on fast enough so that it doesn't go back down into disinflationary territory?
Well, so let's step back from that. I don't know whether we're behind the curve, right? Policy affects the economy with a lag, as we know, long and variable lags. So we've got to make sure that we're going to be taking some of the restrictiveness off before inflation gets to 2%. And so when we're thinking about it, it's really, are we confident it's on the path back to 2%? But then it's a calibration exercise, right? Taking into part both parts of our mandate, right? We want to maintain healthy labor market conditions at the same time ensuring that inflation goes all the way back down to 2%. And so the committee will be calibrating its policy, right, to achieve both parts of its mandate and take into account the risks to both parts of this mandate as it goes forward. So I think that's the way I view it, is that this really is now monetary policy is well positioned no matter which side the risks manifest themselves. And then the work of the committee is to assess those conditions, incoming information, how does it inform your outlook, how does it affect the risks around the outlook, and what is that, the implications for policy. So I think that's what the exercise is going to be going forward.
When you're looking at the outlook for the economy, there's a lot of criticism on Wall Street that the Fed, being data dependent, is always looking at what's happened in the past, perhaps not realizing you're constantly talking with people in your district, with CEOs in your district companies, and getting their views. And I'm wondering how well their views that they're telling you now end up matching up to the data.
So you're exactly right, Michael. The work that we do in the districts is incredibly important because we talk to a number of contacts, business contacts, community development practitioners, labor market representatives. So we have a really good sense of what is really happening in the economy. And right now, what they're telling us is very similar to what's in the data, right? In terms of the labor market, it is easier to hire now than it was a year ago. It is easier to retain workers than it was a year ago. The offers they have to make on wages are lower than they were a year ago. The average for our district expectation for this year is 4%. A year ago was 5%. So that sort of balancing between supply and demand is happening when you talk to businesses about what they're seeing out there. Similarly, there are firms that are telling us that, wow, I wish I had raised my prices higher last year because now it's much harder to raise prices because price pressures and whether the consumers will accept the price increases is coming down. They don't have as much pricing power as they did before. Nonetheless, there's still some. And so that's another indication that, okay, we've done pretty well on inflation getting it down, but we're not all the way back to 2%. And that's going to, again, be something that the committee is going to have to keep assessing. But I would say that what we're hearing from our contacts is very similar to what's in the data. Demand has moderated a bit across firms in our district. There are several firms that say the infrastructure spending and the support from the federal programs they've benefited from it, and they expect to continue to benefit from it. So again, the economy seems to be still on a good, solid, firm stance, and now it's a question of, let's get inflation back to 2%. Let's keep those labor markets healthy.
Well, we're going to get a couple more inflation reports, obviously, before the next meeting. Would you say that July is actually a live meeting in play? Would September be the first one?
I mean, I think all meetings are always in play. Again, it's really going to be about what happens in the economy. So rather than thinking calendar time, I think the better approach is to think about how is the economy evolving? has your confidence been raised that, given the reports that have come in, that inflation is on that sustainable path back to 2%? And I think the committee is going to do that careful analysis, and also assessing what's happening in the labor market. We have seen the unemployment rate move up. It's moved up, I think 0.6% since early last year. So again, you got to assess both parts of the mandate. When we started raising rates, right, we were focused wholly on the inflation part of the mandate because labor markets were strong and inflation was high. Now, right, as inflation has come down, both parts of the mandate now become very important for us to be assessing risk around it. And so I'm confident that the committee will continue to do that as it calibrates its policy rates to the economy as it's evolving and as they expect it to continue to evolve.
You've got a big calendar date in the middle of your meetings that I know you would say doesn't have anything to do with us, the election. But would you say a rate move, if inflation continues to cooperate, is more likely before or after?
I honestly can tell you, and I've gone to a lot of FOMC meetings. Someone told me I went to over 200 FOMC meetings in my career. Not all as a policymaker, of course, as a research director at the Philly Fed. Politics doesn't enter the room. It really is about what can we do with our policy to achieve our dual mandate goals, taking into account what the incoming information is telling you about the outlook for the economy, taking into account what the risk around achieving our dual mandate goals is telling us. And there's nothing about politics that enters these decisions.
Well, it could have an effect next year in the sense that if we got a new president, we'd have new fiscal policies. We've got a lot of problems coming up in Washington next year with the debt ceiling, with budget negotiations, with taxes. How much faith can we put in the dot plot for 2025 and for the forecasts in 2025? It seems like there's so many unknowns that the Fed really can't have any idea what's going to happen.
Well, we do have an idea because we have to do a forecast, right? Whenever you're setting monetary policy, because it doesn't affect the economy immediately, it takes some time to play out, you have to think about what's happening with the economy. I think every business does that. They're all assessing what's going to happen to my company, what do I think the environment is. We're doing the same thing. We have a review of where the economy is most likely to go, but we also understand that as you go further out in the horizon, it could evolve differently than our current expectation is, right? It could be that labor markets, deteriorate faster than we're expecting now. That's not my base case, but it's a possibility. It could be that inflation, even though we've gotten a couple of reports, maybe it hangs up there a little bit longer. The research that we do at the Cleveland Fed suggests that it's going to take some time for inflation to come back down, but it is going to come back down. And so that is always true. And the longer time you go out, right, the less certainty there is about things. So, my expectation is that we'll be systematic in how we adjust policy based on what's coming in terms of telling us about where the economy is going and what the risks are. And that's, I think, the way to view this, right? The committee can't be prescient, right? We can't know for sure what's going to happen. But what we can do is we can assess as best we can where the economy is going and those risks and set our policy appropriately. And if information comes in that suggests that, the economy is evolving differently than we might have thought, we'll adjust policy in response to that.
We have about 30 seconds left. One last time for all the people on trading desks who are watching you right now, any forward guidance for Wall Street?
No, but just understand that the committee and the institution at the Fed really does focus on setting policy to achieve our dual mandate goals. We're very committed to doing that. And we're committed to getting price stability again, inflation down to 2%, while maintaining healthy labor markets. And I think that's the key thing for the Wall Street to understand.
Oh, by the way, Cleveland Indians weren't supposed to be any good this year. They're in first place. Is that because of Fed monetary policy?
Oh, of course. That's definitely the cause.
Thank you very much. Loretta Mester, president of the Cleveland Fed for 2 more weeks. Thank you for joining us today here on Bloomberg. I'll send it back to Kaylee and Joe.
All right, Bloomberg's Michael McKee in New York with the outgoing Cleveland Fed president. Thank you so much. Great conversation. And of course, Joe, the politics come up in the conversation, even though we just heard Loretta Mester say that politics don't enter the room at FOMC meetings. We know that certainly what happens as a result of FOMC meetings and where interest rates go because of them has a lot of influence on politics.
Well, yeah, circle September on your calendar here, right? We'll see how close we can get to the election. Politics drive a lot of conversations on this program, including one that we're about to have, Kaylee, following a ruling today by the Supreme Court. They've been adding opinion days with a lot of cases left. This one brings us to the bump stock ban.
Yeah, 6-3 ruling, the Supreme Court effectively gutting the ban on bump stocks that was put into place during the Trump administration.
That's right.
After the Las Vegas shooting in October of 2017 that killed 60 people, wounded hundreds more, the deadliest mass shooting still in modern American history.
That's right. That's why we're glad to spend some time with Congresswoman Dina Titus, who represents Nevada's 1st District and had a visceral reaction to this ruling earlier. Congresswoman, welcome to Bloomberg TV and radio. We appreciate the time you're giving us today. You tweeted following this ruling, the Supreme Court just gutted a years-long bump stock ban. You call it terrifying, and you end your message with the line, "An angry lawmaker is a motivated one. The fight is far from over." Will you provide a legislative answer to this ruling today?
Well, I already have done that. In fact, I first introduced the bill in 2017, right after the shooting that was in my district, and I've brought it back every session since. It has some bipartisan support, and if it came to the floor, I believe it would pass because the public opinion is so in our favor. We predicted that the Supreme Court would do this from the very minute that the ATF took action. We knew somebody would sue. So the best way to deal with the problem then and now is through legislation.
Well, Congresswoman, as I noted, this did go into effect during the Trump administration, and we know that Donald Trump does have a close relationship with congressional Republicans. We saw that on full display here in Washington yesterday as he met with Republican members of both the Senate and the House, all of whom seem to be, for the most part, behind him. Is it actually Donald Trump who needs convincing here to push for a legislative answer?
Well, I don't have any sway with Donald Trump, and I don't think this is very high on his agenda. And most of the Republicans have been in bed with the NRA for such a long time that they resist this. The ATF under Trump made this ruling to try to circumvent legislation, probably knowing full well that it would be struck down by the courts. We knew it. I don't know why they wouldn't know it. So it was a symbolic gesture, and it's just taken this long to finally have the truth come out. And in the meantime, we've been trying to.
Well, Congresswoman, that really gets to the heart of the question that was before the court, which is whether a bump stock converts a semi-automatic weapon into a machine gun. The court today ruled that it doesn't. Would your constituents disagree?
Oh, absolutely. And look at the dissenting opinion. Justice Sotomayor says if it walks like a duck and it talks like a duck, it's a duck. They looked at some kind of pulling of one finger as opposed to the overall function of the bump stock. You attach it to a gun, it will allow you to fire 400 to 800 rounds in 1 minute. Think of the people you can take out in 1 minute with that many bullets. So it's very clearly a transformation of a regular gun to an automatic gun. Machine guns we outlawed in the 30s.
There will be another Supreme Court decision coming up on whether certain at-risk individuals should be able to apply for a gun license, those who've been involved in domestic abuse. Does this ruling today make you worry about the next?
Well, I worry about everything that comes out of this Supreme Court, frankly. But yes, it does. You know, there's a lot of talk about we need to deal with the mental health problems, keep guns out of the hands of people who can do harm. It's not the gun, it's the person. And yet here's a measure that does just that. We'll see if they strike it down or not. Likely they will, because the NRA uses the argument nose under the tent. Any little thing that we do, they say, attacks your Second Amendment rights. That's absolutely not true. I'm a gun owner. I grew up in the South. Daddy went hunting all the time till had 2 little girls who saw Bambi, and that put an end to that. But we're not trying to take away guns. We just want responsible use of guns the way they're intended to be for sport or for hunting.
All right, Congresswoman, we appreciate you joining us today. That is Democratic Representative Dina Titus of the 1st District of Nevada. Her district, of course, Joe, including the Las Vegas Strip, where we saw those events take place in October of 2017. Perhaps not a surprising ruling from the Supreme Court we got today with the 6-3 decision. The Congresswoman herself said that she expected it, and yet one that certainly is getting a lot of attention here in Washington.
2 weeks of opinions left. We've got a lot more and some big ones, too, including presidential immunity, Kaylee, that we'll be talking about before the end of this month. This is the fastest show in politics, Balance of Power, only on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P trading negative, but in the past few minutes, NASDAQ has turned higher, right to the numbers with NASDAQ, the composite index, up 18, up by 0.1%, but the NASDAQ 100 index, full of big tech names, doing a lot better, up 0.4%. To put that all in context, we have got the S&P lower by 5, now little change, down by 0.1%. The Dow, though, down 109, a drop there of just about 0.3%. 10-year 4.21%, with the 2-year that's yielding 4.69%. Gold now higher by 1.3%, up $29 the ounce. Spot gold $23.33, and West Texas Intermediate crude up 0.2%, 78.77 a barrel. Cleveland, Bank of Cleveland President Loretta Mester says she wants a few more good months of inflation before any rate cuts. She made the remark in a conversation with Bloomberg's Michael McKee on Bloomberg Television and Radio. She also said politics does not enter the room at FOMC meetings. Apple shares on track for their best week since 2021 on a bet that AI iPhones will be the next big thing. Right now, Apple shares down by 1%. Recapping, S&P lower by 7, down 0.1, and that is a Bloomberg Business Flash.
Charlie Pellet, thank you. Welcome to Balance of Power, the Friday edition. I'm Joe Matthew in Washington alongside Kaylee Lyons. We have just received a statement from G7 leaders via the White House as the G7 summit comes to a conclusion in Italy. The preamble begins with, "We, the leaders of the Group of Seven, gathered in Apulia to reaffirm our enduring unity and determination to meet global challenges at a crucial moment in history as the international community confronts multiple interconnected crises." Kaylee, the meetings, whether it was about Ukraine, whether it was about Israel, the global south, featured China as a backdrop for all of them.
Yeah, in fact, I just searched, and China is mentioned in this statement 29 times, which just underscores how heavily it must have been considered by G7 member nations at the summit over the last few days. Of course, we have talked a lot about China here on Balance of Power, and we did so again this morning with someone who has to navigate relationships with the U.S. and China very carefully. The representative from Taiwan to the United States, Alexander Yu, joined us earlier in studio here in Washington, and we began by asking him about the Chinese response to the inauguration of the new president, President Lai, just 3 weeks ago, which was very heavily, in terms of military, a very heavy response. We asked him if he thought China was overreacting.
As President Lai had a Time cover page a couple of days ago where he was interviewed, and they asked the same question, and he said that PRC's trying to absorb Taiwan into one of them is part of their national policy. So that's their ultimate objective. So they're just trying to find excuses to act up against Taiwan. So a free exercise of democracy in Taiwan, presidential elections, it's a subject of discuss from the Chinese side, and that's why they reacted that way. But we are determined to keep the way we live, the way we are, and to keep every 4 years electing our president, and they like it whether they like it or not.
Of course, Taiwan produces 90% of the world's most advanced computer chips. They call it your silicon shield.
Right.
As the U.S. moves to reshore, as we say, semiconductor manufacturing, do you worry that makes Taiwan more vulnerable? Does it increase the risk of conflict with Beijing?
Not at all. I think that there's been debate in Taiwan whether we should keep the shield as thick as possible by having all the production in Taiwan. But with the advent of AI, which is already part of our lives, but it's just the beginning, and more will be intertwined with our daily lives, AI needs a lot of these super chips. And it's not a matter of, Morris Chan, the founder of TSMC, said it himself, it's not a matter of how many dozens of millions more chips we need, but how many dozens of fabs we need. So the need for the production will be astounding, explosion of need for these super chips. And I don't think we can make them all in Taiwan, because we are, after all, a small island. So putting other plants in other countries where rule-based countries where rules are followed We follow the same. We follow the law. We follow the rules, such as United States, such as Japan, such as Germany. It makes sense. We become part of the production chain. We become partners, and actually, in that way, I think we're better linked and better protected because we're partners. If Taiwan, part of the supply chain, is disrupted, we will all feel the danger and the pain. So actually, interconnection is much better than doing everything by ourselves. Besides, the majority of the production will still be made in Taiwan for the time being, for the foreseeable future.
So how is this administration thinking about balancing investing more in fabs, in Taiwan specifically, versus making these investments in the other countries with which you're referencing?
Well, it's not the government, it's the companies, and they
you can do things to incentivize it.
Yes, actually, the entire semiconductor industry in Taiwan was born out of the incentives from the government. When Dr. Morin Chan was invited by the government to come to Taiwan to realize the idea that he had on how to produce semiconductors. But obviously nowadays the companies they think for themselves, and they, profit margin wise, etc. But also, again, it makes sense, and I think it's a good idea to put the plants where rules are followed. There was some production in mainland China, and some are leaving, but for many reasons, economic reasons, hostile environment between Taiwan and mainland China. Mainland China has passed national security laws that infringes on the rights of our citizens. For example, any company or individual aiding and abetting the splittist movements in Taiwan are subject to confiscation of their properties, which means any individual company from Taiwan who are based in China, production, who are paying taxes to the Taiwanese government, they could be subject to those punishments. So obviously, it's a big thing. So putting resources in other countries, it does make sense.
When we consider what's happening in the Taiwan Strait, the tensions that we've seen over the balance of this administration and going back before that, your predecessor at times talked about some of the delays that were being experienced in delivering U.S.-provided military aid and weapons systems to Taiwan. The Admiral Paparo, who was in charge of the Indo-Pac command, was speaking to the Washington Post recently about this hellscape strategy that would involve thousands of unmanned submarines, ships, and drones that have yet to be provided, knowing that President Xi has targeted 2027 for his military to be prepared for such an invasion. Are you concerned now that Ukraine is at the front of the line and weapons delays might grow worse?
Well, indeed, many of the weapon systems that was approved to sell by the United States to our country has been delayed. Many of them we already made the necessary payments. We're still waiting delivery, and that's an issue we are constantly talking and coordinating with the U.S. administration. And the U.S. administration is also in conjunction with Congress. We've thought of different ways to alleviate that process. For example, presidential drawdown authority, which directly, from the president, it gives some of the equipments that are already available, or foreign military financing, which is not only we buy, but also grants that allows us to buy, or even using existing U.S. stockpiles to give it to Taiwan first, and then the money goes back into the U.S. coffers. So we're trying to find different ways to accelerate and equip the necessary military equipment that we need to defend ourselves against possible aggressions. 2027, it's been mentioned a lot. It's sort of like a starting date for Chinese PRC's invasion. Actually, it's a symbolic because it's the 100th anniversary of the founding of the People's Liberation Army. So it's, but again, we know that they are preparing for the possibility of doing this aggression against Taiwan. But we're also preparing, and with the help of many friends, including the United States, to deal against this possible threat.
All right, there you have a special conversation with Taiwan's special representative to the U.S., Alexander Ta Rei Yu. I'm Joe Matthew. alongside Kaylee Lines in Washington. We spent a lot more time, Kaylee, talking about a lot of other issues with the representative, and you can find our full conversation online and, of course, on the terminal. These are issues, Kaylee, that are not going to resolve between now and the election.
No, it's just one area of geopolitical tension that we have to keep an eye on. But certainly there have been a lot of developments in a lot of different places in the world this week. We talked extensively about what happened at the G7 in Italy in recent days. But of course, we began this week, Joe, with a surprise in Europe, with far-right parties performing much better than expected in parliamentary elections across the bloc, really, but especially in France and Germany, leading French President Emmanuel Macron to call for a snap election.
Yeah, so now we've got the UK and we've got France, and an interesting narrative with a tilt to the right in Europe here, Kaylee, and questions about what that's going to mean for politics and the economy globally. It's something that our colleague David Weston is going to be talking about coming up today on Bloomberg Wall Street Week.
Indeed. David's joining us now from New York. You spoke about this with Larry Summers, didn't you, David?
Yeah, exactly. We all went into this year knowing we were going to have a lot of elections. We didn't know we were going to have quite as many. Now we have in UK and France after those European parliamentary elections you referred to. And we did talk to Larry about what we saw, were there patterns in that. And he's very concerned about the populist, he thinks, right of center trend and what it may mean for economies, including here in the United States. This is part of what Larry had to say.
This tendency towards right-wing nationalist economic populism that seems to be sweeping the world, that's occurring in big government welfare states like France, that's also occurring in the United States with much less of a big government tradition. I think it's something that is as worrisome as any other trend in the last several years, and forging an effective synthesis that can appeal to middle classes without resisting connection with the rest of the world, without ugly racist tropes. That's a central challenge for political leaders in almost every country.
Yeah, and as we talk about Europe, it certainly is a challenge as well, I think, here in the United States. I'm not exactly sure how we meet that challenge, because it's pretty clear to me, I know what you think, Joe and Kaylee, but there are a lot of voters out there that are pretty unhappy.
Yeah, that's for sure. When you see a global trend, it really makes you start to think here, David. We just spent a day here in Washington with Donald Trump's return to the Capitol for the first time since January 6th. And there are a lot of questions about what that might mean for our economy. I guess in many ways, the same questions that are being asked from voters in Europe with this turn to populism.
Yeah, and we talked to Larry, actually, specifically about what happened with Donald Trump, the former president, yesterday down there in Capitol Hill in your neck of the woods. And he thinks that what he's talking about, at least what he's discussing, it would be really inflationary. In fact, he says it would be stagflation. The mother of all stagflations would come out of this, in his view. So he obviously is no fan of this at all. At the same time, as you point out, Joe, you have to think there's something broader going on out there, which I suspect is perhaps a combination of lack of robust growth overall, so everybody isn't getting better off, and a lot of income inequality. People who don't see their own situation improving look across the aisle and say, boy, that guy seems to be doing pretty well, and I'm not participating.
Yeah, it's interesting to hear what Larry Summers had to say about this idea that Trump floated to Republicans yesterday, basically raise tariffs so that you can lower taxes. And there's a question about how, even if that works mathematically, what economic ramification that would have. I guess Larry Summers' answer is stagflation. It's worth pointing out, though, David, Joe Biden's talking about higher tariffs, too. In fact, he's already implemented some.
Yeah, no question about it. That's one of the questions, is how big a difference is there between these two candidates on the specific topic of tariffs. But when it comes to really substituting tariffs for income tax, Larry said he thinks that is the worst idea in the economic history of the United States. He went that far, say it's that bad. He also goes back to Smoot-Hawley. We all talk about that drove us into the depression, global depression. He said, look, that was like 0.6 of GDP. If they tried to do it this time, it would be like 6 times that. So what would that do to the economy in the United States and around the world?
There's something about definitiveness that just, just rolls off.
Larry's nothing
David,
but
what else
definitive.
do you have? Yes, that's for sure. What else do you have coming up tonight? We just have about 30 seconds left.
Okay, we've got Ruchir Sharma actually has a new book out, What Went Wrong with Capitalism. He has some thoughts he thinks has to do with a lot of intervention by the U.S. government, maybe a little too much intervention. We've all gotten used to the idea the government come bail us out if we get in trouble, and that's really suppressing some of the productivity growth and the innovation. That's what Ruchir Sharma thinks.
It's ahead on Bloomberg Wall Street Week with our friend David Weston, live from New York, starting 6 p.m. Wall Street time. Kaylee, I'll meet you at 5 o'clock Washington time on the next edition of Balance of Power on Bloomberg TV and radio.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very happy Friday, everybody. Good afternoon, live on radio, TV, YouTube, and Bloomberg Originals. This is Bloomberg Business Week. Carol Master, along with Tim Stanovic, on this Friday, Flag Day, June 14th. Also happens to be my brother Bill's birthday.
Happy birthday, Bill.
Happy birthday, Bill.
He got kind of a happy birthday yesterday when you thought it was the wrong day. But
oops.
Sorry.
Today is his birthday. Hey, checking in on the markets on this Flag Day Friday. You got some angst over what's going on over in Europe. You also had some weak U.S. consumer sentiment data, and that's caused a bit of a pause in this record run-up that we've seen in stocks throughout the week.
Okay, so we have more on that rate reset in just a minute. Also, in the next 60 minutes, the next act for one billionaire who's looking to expand his investing empire.
Yeah, loving this story. It's one of the most read in the past 24 hours. Plus, problem solution. What got IKEA to start paying workers more money? We'll get into that story in just a moment.
All right, and one of my favorites today, wearing shorts at the office. Yeah, it's a thing, and there's a Bloomberg opinion article about it. And guess what?
What?
Well,
you're not wearing shorts.
I'm not wearing shorts right now.
Either is Mike McKee, who we're going to talk to in just a moment.
Let's just say, apparently it's okay to do at the office.
All right, we're going to get into it. You can tell it's a Friday, everybody. All right, let's get you going, though, with a check on the trade and a look at some of your top business stories. Here's Charlie Pellet.
Thank you very much, and here's what's going on. We got NASDAQ swinging between gains and losses. Back in the red right now, 9-point drop there for the NASDAQ Composite Index, but the Dow, the S&P, NASDAQ, all trading lower right now. We are on track for an up week for the S&P 500 Index. S&P right now down 13, 54.20, a drop now of 0.3%. We got the Dow down 157, a decline of 0.4%, while NASDAQ lower now by just about 11 points, drop there of just under 0.1%. Interestingly, though, on a down day for the rest of the market, the NASDAQ 100 index is higher, full of tech stocks. That index up by 0.3%. Your 10-year 4.21% with the 2-year 4.69%. Spot gold up 1.3%, 23.34 the ounce, and West Texas Intermediate crude 78.73, up by about 0.1%. The European Commission plans to allege that Apple stifles competition on its mobile app store. This according to the FT, citing 3 people with close knowledge of the investigation. Apple shares are on track, though, for an up week. We've got Apple trading lower today by 1%. R8 shares, Restoration Hardware, plunging 18.3% after the furniture retailer reported a heavier than expected first quarter loss. Recapping stocks lower, S&P down 12 now, a drop of 0.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, great setup for us on this Friday. Thank you so much, Charlie Pellet. Well, big week for markets, thanks to 2 cooler inflation prints, a Fed meeting, catching the Acela or shuttle. I'm not sure how he got there, but he was in D.C. for the Fed meeting this week. Bloomberg News international economics and policy correspondent Michael McKee, he was at the Fed on the day of the decision, and I have to say, asking a really smart question to Fed Chair Jay Powell, which we'll get to in just a moment.
Are you just saying that because Mike's in here?
No,
okay.
He knows.
Sucking up.
He knows. I do suck up, but he also knows I'm really honest. Mike joining us in studio, not wearing shorts, but wearing some great salmon, or should I say, AKA pink pants.
No, these are Nantucket Reds.
Oh, Nantucket
Reds.
Reds.
You have to have the right.
Blasphemy.
Yeah.
Not to be
These
confused,
are from Nantucket. Actually.
Not to be confused with like a Martha's Vineyard red.
Yeah.
But yeah, Nantucket Red, it's a red.
All right, it's Nantucket Red Pants. What continues to follow you? Focus team. What continues to follow you after the Fed meeting?
The fact that they don't really know what they're going to do, I think, is the bottom line. You hear everybody, and Loretta Mester was just on with us, and you hear from everybody else, same thing, Jay Powell, that we're looking for more data to confirm what we think is going to happen. And when we get that, then we'll consider cutting rates. But we don't know when we're going to get that. It might come next month, might come in 2 months.
You're saying data dependent?
Data dependent, although this is something I brought up with Loretta, and she thinks one of the things that Wall Street gets wrong is the critics say, well, the Fed is data dependent and all the data is backward looking. So they're going to be behind the curve. But they forget that they're constantly talking to CEOs and business leaders and people in their districts who are telling them what they're seeing in real time and telling them what their plans are going to be going forward. So they have the mix of the past data, which confirms or rebuts what they've been told by people, but they have a pretty good idea of what things are happening in real time as well.
Okay, so let's talk about some of that data, because I think it's fair to say, and forgive me, but CPI on Wednesday morning, at least from an equity and bond market reaction, seemed to overshadow what we got a little bit later in the day from the Fed chair. That said, we also got PPI that came in cooler than expected, another Fed-friendly report. Those two bits of data, along with some of the jobs data, not the payrolls report last week, but other jobs data like JOLTS that we got, all seem to fall into sort of one bucket of being Fed-friendly, what the Fed wants to see. But then you have the May payrolls report. That is the outlier here, Mike.
Well,
what's going on?
You have the payrolls report showing lots of jobs created in the establishment survey and 400,000 jobs lost in the household survey. And I did ask President Mester about that, and her view is that you just look at both and you fold it into your overall impression of all of this data that they are looking at. And historically, the establishment data has been more accurate, but you have to take into account the possibility that there's something going on that the household survey is picking up. So they're weighing all of this. In the end, they have a binary decision, raise or cut. And they have to take all of the information that they have and bring it into making that one decision.
I still kind of the Fed obsesses about this 2% target. You did ask Loretta Mester about that, and this was just about an hour ago. Mike talking with the Cleveland Fed president. Let's listen to what she had to say about the Fed getting back to that target.
It's going to take some time to get inflation back to 2% all the way back. So my projection is that we probably won't get there until 2026, but we'll see progress continue in my modal view. And that's enough, right, to then say, okay, it's time to start the process of bringing rates down.
All right, that, of course, Cleveland Fed President Loretta Mester with Mike earlier. Mike, that darn 2% target. What did Jay Powell, I thought there was a headline. I was trying to go through my headlines from Jay Powell on Wednesday. I thought there was something where he kind of questioned maybe getting there. Or that.
Well, he said basically the same thing she said, that it's going to take longer than we thought, and the Fed's kind of modal forecast is that it would take till 2026, the same as she said.
That's 2 years from now.
That's 2 years from now.
But how do we know?
But there's a subtle shift underway here now that you're hearing from Powell. We heard from Mester, and I bet you'll hear from other people too. They're kind of moving away from we have to hit 2%, just using that term 2%. They're not going to move away from the target, but what they're looking for is to get inflation back to Alan Greenspan's old definition of inflation, that it doesn't enter your mind when you're making purchasing decisions. You go to the grocery store and you're not thinking about how high prices are.
So the idea versus the number?
And the idea versus the number, because it's the idea that drives decisions. Now, for businesses, they obviously are plugging into a spreadsheet what inflation's going to be and what their discount is going to be. So it's important to them. The lower you get, the better off, the happier they are. But for the average person out there in consumer spending, if you walk into the grocery store and your first thought is not, wow, that's expensive, then they've gotten back to where they need to be, even if it's 2.2 or 2.3%.
I did think that was a really interesting moment of the press conference toward the end when the Fed chair was asked about sentiment. And sentiment sort of like the old-fashioned way, like, people, what message do you have for people who look at the data and say, yes, things are good out there, but we don't feel good?
We got to read on that today, right?
Yeah, I commend to you and to our audience, if you have a Bloomberg, or if you don't have a Bloomberg, call us and Carol will get you one.
Wow, I didn't know I could do that.
If you can't do that, subscribe to Bloomberg.com. David Wilcox, who was a longtime senior Fed official, has an interesting column out today where he looks at the difference between the Volcker years inflation, where inflation got into big double digits, and consumer confidence didn't fall all that much. And the difference between that and now, when inflation didn't go up as much, but people are extraordinarily depressed. And one of his arguments is that it's the media, that there is a media ecosystem now that you can never get away from the news. And people who don't live in New York and look at their Bloombergs all day long didn't get the exposure to the news about this sort of stuff that they get now. Plus, layer on that social media, which is not just an echo chamber, but it's filled with false information, and then all kinds of people arguing and fighting with each other over this stuff.
Politically, it's a great tool
and
to
that
play
makes
around with, too.
that makes people much more unhappy because they're living this thing all the time. And I thought that was a pretty good explanation. I do an interview with Joanne Chu from the University of Michigan every month, and she was saying basically that makes sense to her because basically there's a lot of things out there right now that are depressing, and she said there is no their survey's been around since 1946, no comparison between then and now in terms of, they have a category called have you heard bad news about the economy? And she said the number is just way, way up now. It doesn't compare.
I mean, bottom line, inflation, it's not going up as much, but it hasn't, we're still paying higher.
It's the level that bothers people because they remember that it was lower before the pandemic, and so now they're saying, well, it hasn't come down.
But it's never going to go back to the price of something pre-pandemic. That's not how inflation works. And I'm wondering if there is a generational issue here, Mike, that there's very many people who this is their first time ever dealing with inflation, so they don't know how inflation works.
Yeah, there are a number of studies that suggest somewhere around 2 years. It takes 2 years to process a level of inflation, as long as it's not still rising dramatically, and then it sort of falls away in your mind. And I don't know exactly what the 2-year timing would be, but that could be as well. And as you say, a generational issue. The older people are going to get over it sooner, perhaps, but the younger people are going to hang on to it for right now. And we have a problem with housing, too, that we haven't had before. There's a housing shortage for a whole lot of reasons, but that's keeping home prices up. And for a lot of young people, that's a big deal.
And that plays into it in a big way. Mike, sit tight. We want to bring into the conversation Michael McKenzie. He's been tracking the wild week in rates that was. He is, as we said, Michael McKenzie is Bloomberg News rates reporter joining us in New Jersey. Michael, you've been listening to us kind of talk about the Fed. We have seen what feels like another major reset in the U.S. Treasury market. Yes, the CPI print in a big way. Having said that, you keep reminding us about the volatility of the market. I want to go back there, though. Do you feel like we are at a point where rates on the high side of things we've topped out, that where we're now is sticky, or who knows?
I think it is. I think the 2 years finding it tough to get below 470. That's because the Fed is for now on hold. So the 2 year really can't drop too much from these levels. And I think talking to people earlier this week, they sort of defined the 10 year as ranging between 425, 475 and 450 as fair value. We're at 421 at the moment. That does seem pretty excessive. Again, the data has helped this week. Initial jobless claims, producer prices yesterday just kind of reinforced the message we got from CPI on Wednesday before the Fed meeting. And I think the market's very much attuned to what Chair Powell said during his press conference. He did allude to the fact that, you don't really follow the dot plot. We're data dependent, hence the market's going to be data dependent. And that's why if you look at odds for September, they're sitting around 70%. We got 3 months of data yet to come before we get to that September meeting. So you can't really rule out the potential for 2 cuts this year. Then again, it ultimately, though, it comes down to the data.
Yeah, 3 months of data is a lot of stuff. So, the tone, is it likely from the folks that what's great about, you're always talking to the different traders that are out there that are in this market. I mean, is the anticipation that we're going to see some data that's going to continue to come in hot? Or is it more that tone that we are increasingly talking about, that the data is softening, generally speaking?
I think it's more the data's softening, and there's the potential for something, a real big downside surprise. And I think that would have to come through the labor market. So the initial jobless claims you got yesterday was the weakest since, I think, August of last year. So it's starting to come. If you are in that camp that you think the economy is a lot softer than people think. There's been a lot of debate about the way looking back at the payroll data last Friday, looking at the 2 different surveys that are used. One person characterized it as, it's like a piece of wood floating in the water. On the top looks okay, but underneath it's rotting. A lot more talk about consumers slowing down. But that said, I think we're very much in a summer where the potential for swings in treasuries can continue because of the data. Every piece of data coming through, and this has been the one constant I've got from talking to people, is that it's an event and it's going to move this market around. And typically in the summer, liquidity does start to drop off. The other factor that's been playing, I think, a role in the rally we've seen this week, of course, has been from France, that the spread between French 10-year over German 10-year has blown out. That brings us on the topic of elections. We've already had a pretty big reaction in the Mexican markets since that election. And when you start talking to people in the US Treasury market, they are mindful that we're coming up to a debate later this month between Trump and Biden. And from there, the clock starts to run on what's going to happen in November and how exactly is that going to pan out and what are the potential consequences for rates, the economy, and even the Fed.
It's funny because I talked to Loretta today about how the market reacts to things and how the Fed thinks about that. And she said the same thing that Jay Powell has said. We have two different jobs. They are paid to take a position on a minute-by-minute, day-by-day basis, and we don't do that. We make a decision once every 3-4 months, right. And we have one decision. So we don't have the same kind of angst and concerns that traders do.
No, it's a super good point. One thing I do want to ask you before you leave, Mike, because I do feel like the question you asked, and I don't know if I've got it perfectly correct, but it was something to the effect about if the Fed expecting rate cuts, later this year, next year, when essentially the U.S. economic backdrop will be the same. I think it was something to that effect. Like, how do you square that?
Well, at the end of this year, their new economic forecast is that growth will not slow. It will be the same as it is right now, and that unemployment will not rise. It'll be the same as it is right now. Headline inflation will not change. Core inflation will actually go up, but you guys are wanting to cut rates. Why? The answer is what I expected him to say, basically, that what happens is if inflation keeps going down, then real rates go up. And so that imparts more drag on the economy, and they don't want that. They think they're restrictive enough right now, so they would need to calibrate the rate to where inflation is.
Hey, Michael McKenzie, help us push this forward to next week and beyond in terms of the next catalyst that you're keeping your eye on for the bond market. We have a federal holiday, Juneteenth, next week, so a holiday shortened trading week. What is the next catalyst on your radar?
PCE at the end of the month, and then from there it'll be payrolls. Okay. I think it's really going to be those big ticket data events.
Wait, we're data dependent?
A couple weeks out then.
All the PCE forecasts that are coming in are really low. So economists are expecting a good PCE report.
Yeah.
All right. Well, interesting.
Which is why the market's rallied so much this week. But again.
Unbelievable. It's just kind of interesting to watch. And I feel like we go through these big conversations and these big events, and it's like we're data dependent, kind of ish. All right, guys, have a great weekend. So appreciate it. Michael McKenzie out there in New Jersey, rates reporter at Bloomberg News. And, of course, our own Michael McKee, international economics and policy correspondent at Bloomberg News here in studio. You did ask Loretta, too, about the Indians.
Yes.
The Cleveland Indians.
Cleveland Guardians.
Guardians, sorry.
Yeah.
Sorry.
Yes. And she said
big baseball fan.
I'm so sorry.
She said it was monetary policy that has them in first place.
I love it.
Clever, man. Not missing a beat. All right, guys. Straight ahead on Bloomberg Business Week, we get to one of the most read stories in the past day. The billionaire building a new asset manager around its crown jewel, Cleveland Guardians.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, all in the red. But look at the NASDAQ 100 index, up now by 0.3%, as many tech stocks continue to advance. NASDAQ, though, right now, a little change, down less than 0.1%. The Dow down 11, drop there of 0.2%. The NASDAQ, the Dow down 149 right now, drop there of just about 0.4%. 10-year yield 4.21%, with a 2-year now at 4.68%. Spot gold down 0.4%. Right now we go to actually gold higher, up 1.3%. Spot gold 23.33 the ounce, and West Texas Intermediate crude, it is flat on the day right now, 78.61. Tesla shares today, we've got Tesla lower by 2.4%. It has officially shifted its incorporation to Texas from Delaware, according to paperwork filed with the Texas Secretary of State's office. Apple shares on track for the best week since 2021 on a bet that AI phones will be must-haves. Apple shares today, they're declining. We've got Apple down now by just about 1%. So again, recapping, stocks lower, S&P down 10, drop there of 0.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, it is expected to launch with at least $65 billion in assets, likely the next 6 to 12 months. A new asset manager created by billionaire Todd Boehly. And in doing so, he is said to be talking to sell a stake to investors so that he then can build out and bolster his crown jewel in the insurance area. So let's get to it.
We got with us Bloomberg News global finance correspondent Sonali Basak here in the studio. So first up, Sonali, for those people who are not familiar with Todd Boehly, give us some background here, and why do we watch what he does?
Well, in recent years, his presence in the sports world is one big reason he's more widely known. He's an owner of the Dodgers. He's an owner of the Chelsea Football Club. But the other reason people really know him on Wall Street is he's a billionaire who really built his claim to fame by being one of the early creators of what we now know as Guggenheim Partners, the asset manager.
Huge, right?
Right. And so Guggenheim Partners is a large company, as we know, but the asset management business was really built on the back of pretty complicated credit instruments and this insurance company play that a lot of companies have really gotten into after 2008. They bought insurance assets when they were cheap after the financial crisis, and it's made some asset managers across all of Wall Street much, much larger. You think Apollo now owns Athene, built it through acquisitions in the wake of the 2008 financial crisis, and now Apollo actually owns that insurance company, Athene, outright, and it has really fueled the growth of its asset manager. Similarly, KKR owns Global Atlantic, another company that grew very quickly after 2008.
What's the insurance play? Is it just that there's so much money and assets then to play with? Help me understand.
Sure. So what happens is an insurance company, you know, often has life insurance policies, other types of insurance. They hold on to that float. It's very Warren Buffett-esque. They use that float in the meantime, and they invest it often in credit instruments. This is why credit firms in particular love this insurance play. It's not like they're plowing it into a bunch of private equity wagers with tons and tons of risk, although there had been debates in recent years on how risky this is to have traditional private equity, private credit get into insurance in this really big way.
So, go ahead, Carol.
Well, where is the credit that it goes, right? Because you want to make sure that the credit is good credit.
Exactly.
Top tier.
So this is the big intellectual debate that's happening in the asset management community now. If you look at like the MetLifes, the AIGs of the world, they tried to keep it in pretty vanilla, real estate, CMBS, treasuries, but now it's interesting because there's also CLO markets and leveraged loans and other kinds of private credit that people are looking at. So let's go back to Todd Boehly for a second here, because what he's doing is he's taking the insurance company, Security Benefit, then also creating an asset management arm of this new company that takes 6 existing asset managers. What types of assets? Equipment leasing, CLOs, real estate. So all sorts of types of credit instruments here. And the trick here with all these asset managers is making sure that those stay in safer instruments, because to your point, these are insurance companies, aren't they?
Exactly. Said to be kind of steady.
So that's my next question isn't plain vanilla really good in this situation? Because if it's an insurance company, they could be caught off guard by a large payout from, let's say, a catastrophic event or something unforeseen that hasn't hasn't been modeled for.
Here's the other thing that I find kind of frustrating with the language around how we call this insurance play. Yes, these firms are buying insurance companies, but by and large, what they're doing is expanding not just traditional life insurance companies, they're expanding annuity companies. Annuity firms are more like savings products, really. They're not like life insurance. They don't pay out when you pass away. They pay out over time, kind of like any other retirement product would. And so in some ways, there's even more of a liquidity need. But they've become very popular because as people are aging in the United States and elsewhere, they want additional income. They want to know what they're going to get on a monthly basis, on a yearly basis as they pay for their retirement. But yes, the way they invest those assets, you know, it's a tough calculation. It's a calculation that every investors are making. Every investor is making. How do you find that extra yield and what is safe? Some of these guys will tell you, you thought real estate was safe.
Correct.
You know, insurance companies sitting on hordes and hordes of office properties right now. What is safe in this environment anymore?
Well, because it's interesting, because I felt like at Milken that was one of the main themes of like the private credit area looking to tap into the deep pockets of the insurance area, like you're talking. And it just starts to make me a little nervous. And I just wonder, have we had any problems? I'm sure regulators are keeping an eye on it, or are they?
So regulators had been keeping an eye on it pretty significantly, and they had been discussing in some form some types of rule changes. By and large, listen, this has only really proliferated over the last 10, 12 years. Since I've reported on this as well, it's only grown in size to a significant degree, and traditional insurers, let's take AIG for example, they have outsourced a lot of their investment management, and AIG is a fraction of the size that it was before the financial crisis. So at the end of the day, that's the debate. When you're handling all these insurance assets, is it better to allow people who spend their entire day job doing this, or letting the insurance company alone manage it in-house? It's the same question for pension funds as well.
So back to Boley, the story that you reported. Great context, by the way. You're reporting that shows that he's even considering taking this public, this type of company.
So this is the other thing about this. We've talked about how the Security Benefit Company, which is, by the way, is one of the top 10 annuity sellers in the United States. There's Security Benefit, those 6 asset managers, combining them into a $65 billion. It sounds pretty complicated. $65 billion.
I want the whiteboard.
I know, but Boley is known for this, building asset management giants. The reason that this is getting interesting is because he's, according to our sources, potentially raising money for a stake sale in this new asset management business. There's a plan to maybe take this public one day, maybe sell one day, but also in the interim, this is where it gets really interesting. He's planning to potentially buy a lot of assets in the meantime. He's looking at asset
plain
managers.
old M&A.
Plain old M&A to build up that asset manager. And our sources say that, remember, he was one of the ones that was bidding for Hayfin, a private credit firm in Europe. That's just the start of it. He's looking for firms between $3 billion and $50 billion in assets under management. And so you see this in a lot of places. Ares, too, we reported this week, is looking to do one of the largest asset management deals in alternatives that we've seen in recent years for a real estate company. A lot of companies looking to merge right now.
I have to say, to me, I was kind of like, okay, he wants to do this, but also raise money and then do this. And like, for someone who follows this world, I mean, what's the significance of it in your mind? And again, this is, it's not confirmed yet, right? Or
So this is something that is expected in the next 6 to 12 months, pending regulatory approval. To your point, insurance regulators in particular do approve this kind of stuff. But they are talking to investors about it. That's according to all of our sources. We'll see how they end up structuring all this.
What's significant to you, though? Like, you follow this
He is one of the biggest deal. You know, people know him for his sports. Yes, the sports part is fascinating. It's fun to cover. It is fun to watch. But he's become a billionaire off the back of these kinds of deals. The reason he's significant in asset management and in the credit world are deals like this. You may remember a while ago, he built a CLO business and sold it to Carlyle. So now that business is a significant part of Carlyle's own credit growth. And of course, private credit is hot. The asset management world is hot. This is all part of the broader evolution we're seeing in the asset management world.
Yeah.
And this guy's a serious contender.
One thing that all of these things that you're talking about have in common is scale. And I'm wondering why all of these asset managers are focusing on scale.
Well, a few reasons. One thing that we hear a lot is if you go out to your pension funds or insurance companies, they don't want to invest. They don't want to spend all their time meeting with a million different managers. they want more one-stop shopping, but also knowing that those managers are sticking to their knittings. That, you know, real estate manager A that's known for amazing real estate wagers is not going into private credit without having the right private credit expertise. And so there really is not a lot of consolidation for consolidation's sake, but there is a lot of consolidation because the larger survive much more simply because the larger keep getting bigger because they have those relationships with those fund managers and larger investors.
It's just fascinating that the rise of the private markets and all its little iterations or all assets and I just wonder what that means for kind of the retail investor. Like, are they continually kind of squeezed out of this?
Well, you know, you could argue that the retail investor is feeling this. We were talking about the annuity business a little earlier. That is retail money. And all these folks, too, are also looking at retail money by trying to change the form of their funds so that more retail investors could get in. This is a pivotal moment to see how that works, isn't it? When we look at kind of BREIT, the Blackstone Real Estate Fund, and other similar funds, how they've worked in terms of providing people liquidity in times of relative stress. We're watching an experiment unfold in front of us. And the retail investor is very much the type of investor that they're trying to eventually get to.
Again, go ahead.
No, go, please.
I want to talk about Shonali's newsletter.
Oh,
so
yeah, let's do it.
So if you don't have another question.
No, go.
Okay.
Go.
Shonali, Wall Street Beat. Everybody should subscribe to it. It's your newsletter. You talk about private equity's moment. It could eventually come. We've been speaking about this for quite a bit of time, actually. And we had a guest on last week, Jared Dillian of the Daily Dirt Nap, who's been very bearish on private equity in recent months. What did you find about private equity in this newsletter?
It's so easy to be bearish right now because if you look at it, they haven't sold assets at scale recently. Bankers keep telling us that IPOs, even though they've come back, they haven't come back well for private equity. And they haven't come back for M&A either. Morgan Stanley's head of the Americas M&A says he thinks it's going to be 25, 26, 27. So the next 3 years. You feel bad now, you've got to wait a while, apparently. So hopefully it'll come back over the next 3 years.
What does it mean for the private equity guys? I mean, you know, you either mark down, right, your assets, right, or willing to let it go at a much cheaper rate, or you've got to kind of refinance deals, right, to kind of keep it going.
At a higher rate.
At a higher rate, which could be problematic for those who are borrowing. So it's like, I keep feeling like we're just kind of, like, what's the pain here?
There has been stunning. There's a stunning amount of debt deal activity that's going on. The longer these private equity firms can't sell assets, the longer they have to go by telling their investors, hey, wait a minute, you have to wait to get your money back. Those same investors are not putting new money to work because they didn't get their old money back. And so those private equity firms are going to the debt market saying, we want net asset value loans. We want dividend recap loans. We want other types of vehicles here so we can leverage up again and give that money back to investors. It's controversial because if you do that, it's an opportunity cost. If you're borrowing now for that dividend, you might not be able to borrow as easily for M&A in the future. And so...
And you're assuming the market's going to get better in a year.
Absolutely.
Or 2
You're
years.
taking market risk on as well.
Fingers crossed.
So it's been a tough calculus out there.
You are the queen. Bloomberg News Wall Street reporter Shonali Bossack joining us right here in studio. Thank you so much. Coming up next, how to get workers more pay? Just ask a Kia. That's coming up.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. A renewed wave of anxiety gripping global markets today as concern about that political crisis in France deepens, driving stocks down. Here's where we stand right now. We have got the S&P lower by 12. And that is a drop right now of 0.2%. The Dow down 126, lower by just about 0.1%, while NASDAQ is down 16, a decline of 0.1%. 10-year yield 4.21% with a 2-year 4.68%. Spot gold up 1.3%, 23.33 the ounce, and West Texas Intermediate crude oil down 0.2%, 78.48 a barrel. Adobe shares pushing higher after earnings. Adobe now up 14.4%. They are seeing their biggest gain in about 4 years after projecting strong future sales for its suite of creative products. Again, recapping, stocks lower, S&P right now on track for a winning week, I should add. Right now, the S&P down 12, a drop there of 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Carol Massar along with Tim Stanovic live here on Bloomberg Business Week. A story we have been dying to get to. We've touched briefly on it on air. Workers at one particular company quitting in droves with half of all new hires leaving before their first anniversary. Bummer and costly.
Costly is the important part to focus on here. With more, let's bring in Bloomberg News senior management and workplace reporter Matt Boyle. He's here in our studio. The story centers around a company that I think everybody knows, and perhaps in their 20s, 30s, maybe 40s,
because
and 50s
of the bully bookshelf.
knows well. Exactly. IKEA is what we're talking about. It's a unique company for a lot of different ways. But what did you find when it came to turnover?
I mean, what I found when I came to turnover was some things that are endemic to retail. You know, they were having an issue, but also through this kind of Swedish lens where they're actually like, well, let's try to do something about this. We're in so many different markets, and there were different pain points in each market, which has really made the story interesting. In some parts of the world, it was simply just pay. You know, we want to be paid more. We want to be paid equally. Gender pay gaps were in existence. In other parts of the world, it was onboarding. New employees felt lost. No one was talking to them. They were just sort of like, what do I do here? In other parts of the world, it was benefits, you know, paternal leave, for example. In India was one thing. And then the U.S., shockingly or not shockingly, it was about shift scheduling, which is just a real bugaboo.
We often talk about it being expensive for a company when an employee quits. How expensive was it for IKEA?
For IKEA, they were telling me it was $5,000 a pop to replace someone who left. And to be honest, that might be low, because I've seen plenty of other estimates from HR experts who say it can cost nearly 1x or 1.5x the salary of someone to replace them when they leave.
Because of the training and like what?
Yeah, you got to pay someone to hire a new person.
Yeah.
You got to pay someone probably to also manage the exit of the first person, hire the new person, train the new person, and then you lose productivity because that new person is not as productive or as efficient as the person who left.
And during the pandemic, you had to find
that was the other
which is still an
big
issue, right?
Huge problem during the pandemic. I mean, look, the Great Resignation hit everybody, but it hit few industries harder than retail. Retail work has always been tough, low paid, long hours, annoying customers. But then during the pandemic, all of a sudden, every retailer was now an e-commerce fulfillment center. Right. You had people picking up orders on the curbside. Remember that?
It's frenetic.
And then you've got people coming in who don't want to wear a mask and are like, spitting on workers and all this horrible behavior. So some retailers were handing out hero bonuses, but that was just the depths of COVID. Those ended. And so retail, they see voluntary turnover rates, quit rates, 70% higher than most other industries.
I'm a little surprised because IKEA is it gives off a warm and fuzzy feel. You know, the home of the rubber ball pits for kids to play in, those great bags for shopping, Swedish meatballs, dare I say
couples fighting everywhere.
Yeah, they've got this sort of Nordic vibe going, and which is great. But again, remember, these are hourly retail jobs, and they were getting in trouble all over the world to the point where it wasn't just one union in one country that was complaining. They had an umbrella union put forth a complaint to the OECD saying we are being treated horribly, there are different standards in different markets, and it went all the way up to the top. It took years to settle. They finally came to an agreement, but while this is going on, workers were just leaving in droves.
There's one stat in the story, I just got to go to it. By 2022, more than 62,000 employees were departing a year for various reasons, equating to about a third of its workforce, and the pandemic-era labor shortage made it difficult to replenish its ranks. That number, though, is staggering.
Yeah.
That's a lot.
It's very rare, and kudos to them for at least disclosing it. Because you ask Walmart or Dollar General how many people quit last year, you're kidding? You're never going to learn that at all. So IKEA, is in their sustainability report. Now, granted, that number does include workers who were involuntarily departed, so who were fired, but still, the bulk of them were voluntary quits, and that was a peak, and that's when they realized, we have to do something about it. At the same time, it's hard to find new people.
Okay, so you talk about doing something, and it depends on the country that IKEA was in and operating in, and what specifically those employees were looking for. But how would you characterize the big change that they've made at the company in order to retain workers better?
I mean, the big chain, look, when it comes down to people say, I want to work for a company that supports my values and that has a purpose, but let's get, it's pay. Pay and benefits is what holds on to people. And also whether or not they feel there's a career path at the company. That's another big thing. You might enjoy your job, but you're like, I don't really know where this job is going.
Right.
That's a huge problem, especially in hourly retail. It's like, maybe you don't need to work stocking shelves the whole time. Maybe you could work in customer service. But companies are very bad at telling their employees, we see this path for you.
Right.
Because that takes time and investment and money, and who's got time for that when someone's making $14 an hour, right?
How much did work-life balance come up? I feel like, there was so much after the pandemic where people were talking about it. Employers were saying, we hear you, we understand. It feels like it's sliding back a little bit.
Yeah, they were saying we hear you, but then it was often like, hey, let's have a pizza party, or hey, here's a free app for wellness, call it a day. It was
go meditate in the corner.
Yeah, exactly. Go meditate. Here's a yoga mat. Have fun. That's not going to do it long term. Especially if you're dealing with burnout, anxiety, stress, serious mental health issues in this workplace that companies have just sort of taken these token approaches to. So at IKEA, for example, yes, all workers were asking for more. I remember in India specifically, for example, a lot of companies in India demand that their workers have a 6-day work week. IKEA said no, 5. So also paternity leave, a big rare thing over there. A lot of mothers were often getting leave, but not all dads. And even if dads were getting paternity leave, they weren't often taking it. So the real encouragement, you have to tell people, you can do this. Give them permission. That's a big part of all this.
You're not going to be penalized for taking it is a big one.
To what extent is IKEA an outlier globally when it comes to the sector?
They're an outlier just for giving me this data. My goodness.
Yeah.
It'd be great if more companies would actually, they talk a good game.
Well, and it's a privately held
Yes,
company
that's
too.
the reason why. They don't have Wall Street to answer to. It's a very weird structure. You have this parent entity that controls, their licensing and franchising and product design, and then you've got this company called Inca, which is actually the company I talked to. They run the stores. They hire the people. They're like the franchisee, in other words. So, but they're massive. They employ nearly, 165,000 people.
It's a lot of people. Hey, I wonder if they gave you any data on wearing shorts at the office. This is another Bloomberg opinion columnist that's out there.
Yeah.
You have your own story about wearing shorts.
I wouldn't wear shorts if I worked retail. That's a lot of hard work, and you get a lot of skin knees there. But yeah, wearing shorts at the office is yet something. All these norms in the workplace have fallen by the wayside. Is wearing shorts, especially as a guy, is that also going to fall? Look, I wear sneakers every day to the office. I never would have thought of doing that pre-COVID. So is shorts the next, big thing to fall? I'm not sure.
Have you ever done it?
I did it once in the late 90s, my first job in New York. Everyone stared at me and my hairy legs and said, Boyle, no. That was the last day I wore shorts in the office. So, today's casual Friday, though I'm wearing jeans. That's as far as I'll usually go. But, jeans can get pretty hot in a New York summer. So, but I'm a bit more old school about this. I'm Gen X. I don't see myself wearing shorts. Now, on work from home days, anything goes. And that's what's influencing, obviously, in Sarah Green Carmichael's column, her great column today. That's one of the things that is driving this. It's like, well, I was wearing shorts 5 days a week during COVID. Hey, who's gonna ask twice?
Also, just so you know, heat wave in New York starting next week. So
says the guy who throws on shorts to go home.
I wear them. I wear shorts into the office because I ride a bike. then I change
Everything
a
is
suit.
There's a lot of change. Presto change does happen.
The problem is the people who see me wearing shorts on the way to changing. That is.
I want to get on a ball and start like
and then
kicking
having
it around
Carol
with
make
you.
fun of me whenever she sees me, which is every single day.
It's really kind of charming. You are always charming as well. Thank you for always pitching stories and reminding us of some great stuff that you guys are doing. Matt Boyle, he's Senior Management Workplace Reporter at Bloomberg News, not wearing shorts. This is Bloomberg.
Company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. The European Commission plans to allege that Apple stifles competition on its mobile app store. This according to the Financial Times, citing 3 people with close knowledge of the investigation. The Commission has determined that Apple is not meeting obligations to let app developers steer users to offers outside its app store without imposing fees on them. Apple shares right now on track for a winning week, but Apple today lower by 1%. Some of the other stories that we are following for you at this hour: Apple is being sued by 2 female employees who claim it systemically pays women less than their male counterparts for similar work, and who are seeking to represent thousands of other women facing the same alleged discrimination. Alphabet will have to defend itself at a trial against all of the U.S. Justice Department's claims of a Google monopoly in online advertising technology after a federal judge rejected the tech giant's request to decide the case ahead of time. A federal judge in Alexandria says this will go to trial as expected in September. Tesla has officially shifted its incorporation to Texas from Delaware, this according to paperwork filed with the Texas Secretary of State's office. The move unites the company's legal home with its physical headquarters, which have been in Austin for years. Yesterday, shareholders also approved Elon Musk's pay plan. Tesla shares lower now by 2.5%. And federal aviation safety officials are investigating a Southwest Airlines flight that experienced an unusual rolling that may be linked to a damaged backup power control unit. And those are some of our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stennebeck on Bloomberg Radio and Television.
All right, everybody, what a week for U.S. stocks. 4 days of back-to-back records. What a week for U.S. rates. That is, Tim, the backdrop for today's Options Insight.
With Stacy, Director of Strategy at Optimal Capital, talking gold and rates. Abigail, take it away.
Absolutely. Thanks so much, Tim. And Francis, great to have you with us. And as Tim was just mentioning, and Carol, rates really back in the spotlight, well, always in the spotlight over the last several years, if not decade, or even ever. Let's just go big there. But this week we have yields back lower right now, providing the backdrop for higher for stocks as yields go down, stocks going higher. Gold, interesting though, over the last 2 months really caught in a range. Do you think that gold investors are seeing it more from the standpoint of the Fed is going to turn dovish, or do you think that there's some kind of an inflation tell here, or both?
Well, I think that the sell-off in gold was coming from this idea that inflation could either reaccelerate or become sticky. And obviously we had the softer inflation print. And if inflation goes back up, being that gold is negatively correlated to real rates, then you could have real rates going down I'm sorry, if gold is negatively correlated to real rates. If you have inflation going back up and you have rates going back up, you could have to watch that. But the 10-year basically could have a technical bounce around 418 from March 28th. And if it falls through that, it's probably going to go down and test March 11th at 405. And so just watching that, if inflation goes down, real rates could move higher. So that's the thing to watch. But inflation should be maybe sticky and growth should be kind of falling, kind of coming towards the end of the second quarter and into the third quarter, because basically some of those lagging indicators coming into CPI. So I expect gold to hold the recent low from May 3rd of 210.71.
Yep.
Hanging in at 215 on the GLD right now, and probably going to go back up and test that double top resistance at 225, meaning that you could go long on gold, you could buy calls, you could sell puts. But just watching for that technical bounce on the 10-year, because that's the thing that's going to get you if it goes up too far.
Yeah, it's interesting on
it
gold.
It should make a lower high.
It really seems like it's a good play for either side, whether it's inflation going higher, because then you could see gold going higher, or if rates go lower and some signal of the Fed being dovish, that would be good for gold too. However, somebody was just telling me that gold right now is being used as a hedge against a potential recession. What about that idea?
Absolutely. You definitely have some inflection with consumers as default rates are slowly but surely rising. We don't see that in credit spreads just yet, but that could happen at any time. The consumer could, have damage and fall off or weaken significantly at any time. And obviously gold is it's a recession play for sure. The only thing to watch is if inflation falls dramatically and it's not attendant to kind of any weakening in the economy, then you're going to have, real rates coming, going up and then gold going down. I'm getting tongue twisted. It's been a minute since I've been on air.
Yeah, it's all good. Great perspective, Francis, for us on this Friday. Thanks so much for joining us, Francis Stacy of Optimal Capital. Carol, back to you.
It's all Friday. We get a break on Friday. That's just the way it is. Gotta say, when she said if inflation drops dramatically, that was kind of caught my attention because that's not been our mode, right?
Exactly. That's why it's so surprising to hear something like that when it's been so stubborn getting, especially, I guess, that last mile.
Yeah, exactly. All right, for those of you you sticking around on television. The close is coming your way in just a moment. For those sticking with Tim and me, Bloomberg Business Week continuing. We're going to get to the one stock that rules them all since its IPO last year.
Also, a preview of What's Up on Wall Street Week. We're joined by David Weston.
Looking forward to that. And we're going to be joined by Sarah Kate Ellis, the president of the LGBTQ advocacy organization GLAAD. We're talking about pride at a complicated time. I'm Carol Massar along with Tim Stanovic. This is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stanovic on Bloomberg Radio.
All right, everybody, we're just 60 minutes away from the closing bell, getting ready to wrap up the Friday trade on this July. See, what do I keep doing that?
Interesting.
What's wrong with me? It's June 14th, Flag Day. I don't know.
Yesterday was the 13th.
Time flies.
Tomorrow's the 15th.
And I don't even want summer to go fast.
I don't either, especially next week. Abigail Doolittle reminding us how hot it's going to be in New York.
Well, maybe that's it. Oh, she's like, yay.
Oh, she's excited about that. Okay.
We love warm summer days. All right, first, we're going to look at the markets, folks. It's kind of a meh day, but it's not been a meh week when you either look at equities or rates, so we'll tackle that in just a moment.
Also, that one stock that rules them all since the IPO, we're going to tell you all about the company with the, quote, unprecedented valuation.
You been eating there?
I haven't been eating there. I have eaten there.
Okay.
Yeah. Does that make sense?
To be continued.
Yeah. It's fine. I just, I don't really go to restaurants.
Yeah.
Who has time for lunch?
When you have little kids, too.
Who has time for lunch?
We never go for lunch. Preview of what's coming up on Wall Street Week with David Weston. And then we've got a really great guest that's going to wrap up our show later on.
Yeah, Sarah Kate Ellis, the president of the LGBTQ advocacy organization GLAAD, is going to be with us just in the midst of Pride Month.
We're going to talk about what's going on with Apple this week, too, because it's been on a tear. First up, though, let's see what's going on in this Friday trade. Let's go back over to Charlie Pellet.
Hi, thank you very much indeed. 59 minutes to go ahead of the closing bell. Right now we got the Dow, the S&P, both in the red, but NASDAQ turning positive barely since our last update, up now by just about 1 point. NASDAQ now at 17,669. S&P lower by 8, drop there of 0.2%. The Dow down 97, decline there of 0.3%. Indeed, a renewed wave of anxiety gripping global markets as concern over a political crisis in France deepens. 10-year 4.21%, with a 2-year that's now yielding 4.68%. Gold up $29 the ounce, $23.33 on the precious metal, up 1.3%. While West Texas Intermediate crude just about flat on the day, down less than 0.1% right now, $78.59 a barrel. Federal Reserve Bank of Cleveland President Loretta Mester says she still sees inflation risks as tilted to the upside despite welcome news in the latest data. Mester was interviewed on Bloomberg Radio this afternoon by our Michael McKee.
And I think that's going to be the work of the committee going forward, assess incoming information about the economy. Does it change your outlook? Is it consistent with the modal outlook? And as inflation comes down and as inflation expectations short run the year ahead comes down, then it'll be appropriate to reduce that Fed funds rate and remove some of the restrictiveness.
And the Cleveland Fed president also told our Michael McKee that politics does not enter the room at FOMC meetings. Shares in cruise operators trading lower after Bank of America said the prices polled in early June were modestly softer in ocean markets relative to early May. Today, Carnival Corp down 7.2%, Royal Caribbean down 4.5%, Norwegian Cruise Line Holdings lower by 7.4%. Again, recapping, S&P now lower by 7, drop there of 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. Well, as we just heard from Charlie and Carol mentioning earlier, kind of a mad day when it comes to the equity trade. Investors tapping the brakes on the S&P 500 and the Dow after a week of record closes. Bring up a name like Apple, Carol, and whoa, the stock alone up more than 8% just this week.
Yeah, it's been quite a run. Watching it all, tracking the trends, the momentum or lack thereof, in a week where U.S. Treasury rates also had a major reset, is our own Bloomberg News Chief Markets Correspondent Abigail Doolittle joining us here in studio. What a week.
What a week.
So, As we kind of have a moment, I feel like, to kind of take a breather on this Friday, how are you thinking about kind of some of the interesting trends, maybe breakouts to the upside, to the downside?
I'm definitely looking at that Apple breakout. It's really pretty amazing, given the fact that you had Apple basically in a bear market from the December peak to the April low, and then over the last 2 months, up about 30%. But this week alone, up more than 8%. And it's gone into a technical structure called a flag, or it appears to be, which could mean that it's consolidation. It's the bulls waiting to actually take the stock higher. On the other hand, you have Apple right now is caught in this very strong range, suggesting it's going to be the reverse. It's very tough to play out, but I would say the fundamentals support the idea that it should go back lower, given the fact that there's single-digit growth.
Go back lower.
Lower, yes, only from the standpoint. So I would say the technicals. The reason we use charts, or one of the reasons we use charts, is it really displays all of the thinking of the bulls, the bears, the psychology, the fundamentals. And so typically it gives you an early read on what could be next. But right now that chart's right in the middle. Again, there's something that looks like it could be bullish, but it's within a range where the seller should quote unquote, should pull it back down. I'm on the side of that it will go back down, matching it with those fundamentals, single-digit growth, sort of a weak AI reveal, valuation that is like 30 to 40% times.
Apple Intelligence, come on!
But that's what's surprising me so much about this run-up, Abigail, is that every observer on Monday was pretty much like, okay.
Yes, exactly.
Show me what's exciting about
I don't think that this has to do with AI.
That was my question. What does this rally then have to do with?
So I think what it has to do with is the fact that we had Apple down in a big way. Yes, that had a lot to do with the Berkshire selling. When I was watching a breakout, I've never seen a big cap stock like this break out of a range in 2 days, where at one point it was up 14% in 2 days. That was the best 2 days going all the way back to 2008. And when you think about that, those were those big dips and then those big bear market rallies. I was thinking this is either a big buyer in the way that Berkshire was coming out, it's just going to be steady, or there's something else going on. I think the other thing that could be going on is it was being used as a funding short on the way down. So that if you think of it as a seesaw, if you have Apple on the one seat, and then on the other seat you have NVIDIA and Google and Amazon. As the money comes out of Apple, it goes into these other big tech names. Yesterday it was very interesting. We had Microsoft, we had Google, we had Meta, all down more than 1%, but we had Apple going higher. So it's a way for some big tech investors to have their cake and eat it too, where they sell some of the names and then the others go up. But when we put it all together, I really do think that we're going to see some consolidation for Apple.
Where should we go next?
I want to go back to Mike McKee, because he, while we're sitting here, sent me another email. Not only did he interview today.
Wait, is he still here just waiting for ice cream?
I know. I always think of. I actually had ice cream today, and I always think of him because he's always the ice cream Friday guy. But he's also our weatherman. A lot of people don't know that. So he sent me another chart. So next week, why are meteorologists concerned about next week's heat dome in the eastern United States? Computer model analytics suggest it will rank near, if not the most intense level on record for the time of year. 100 here, 101 in the city. I cannot wait. That's like just such an exciting moment for me. But so
I thought there was going to be an economics connection here.
Well, let's try to. So I also did ask him. So it's interesting. Some of the industrial manufacturer companies.
There it is.
Not so great right now. One of them in particular, MSC Industrial, they missed in a major way. At one point, that stock down more than 10%. Very consistent with Lincoln Electric, Parker Hannifin. People expect them to guide down. But there appears to be a glut of manufacturing equipment in the channel. They don't call it the inventory, but that needs to clear out before there's demand. So my question to Mike was, are there any signs that we could possibly have a recession this year? Could that sneak in? He said no. Mike McGlone, on the other hand, two Mikes, I reached out to him because last year he was saying with the decline in commodities down more than 10%, that was a signal that we could see some sort of a recession this year. He thinks yes. He thinks that there could be. And then you put it together with the weak UMISH. I mean, we just continue to have all these mixed signals. It's hard to know, we have these big tech names just absolutely soaring in the last quarter, putting up good numbers, and then we have some of these backbones of the economy doing a little bit less well. It's going to be interesting to see it all
JP Morgan reports earnings on July 12th, so we're not so far away.
Wow.
We are not.
I know.
We're never far away from.
Is that crazy?
Yeah.
We just had Adobe earnings last night.
It's so funny. There's one of my gainers, and they're like, I can't remember who it is, but they actually came out and said, okay, we're going to be reporting. I think it was Netflix. They came out with a press release. We're going to be reporting earnings, and they gave the date, and I was
the
like,
stock moved moved higher because of that?
Well, not necessarily, but they just put out a release today, and I was kind of like, I was researching it, and I was like, oh my God,
We're always in earnings season.
We're like, it's starting again.
Truer words have never been spoken. That is the fair thing to say. Yeah. Sometimes it's summer, sometimes it's winter. It's always earnings season.
Earnings season.
The big broad picture of what we saw in the S&P and the NASDAQ, 4 days of records, right?
Yeah.
Right, one after another after another. We were waiting to see if it would be 5 in a row. It doesn't look like it's going to be that way.
For the NASDAQ right
maybe,
now,
right?
potentially. For the composite, we're not sure. For the NASDAQ 100, yes. The stocks, yes. We have chip strength, although the stocks itself is up just slightly. NVIDIA, I should say, is up strongly again. It's, of course, up 1.7%. You know, I'm glad you're bringing this up, Carol, because it's reminding me of the Russell 2000, which is down 1.7% today, down on the week, down for a second week in a row. You have the Dow Jones Industrial Average. I know a lot of folks don't watch it, but it is also down. So you have this continued divergence between the S&P 500 and the NASDAQ and the stocks on the one hand, big tech pressing higher or growth, and value on the other hand pressing lower. So this divergence that people for years have been saying is going to come back together, it's not coming back together. Another piece of the puzzle that's out that we just have to try to figure out.
We're shaking our head because it's like, right, value.
NVIDIA at another record.
Exactly.
Up 166% so far this year.
It's unbelievable.
I know.
It's sickening. It's you know, it's interesting.
Is it really sickening?
Well, as from a pure so that's a great question. From a pure stock standpoint, it's just sort of crazy to think that the world's third largest company is up 160. What kind of silly world is that? There's so many people out there saying,
I mean, you
there's
bought
too
your
much
NVIDIA
liquidity,
chips, right?
FOMO.
You bought your NVIDIA chips.
Oh, of course, in my back pocket.
Yeah.
The Blackwell chip.
But there's a lot of to your point, yes, a lot of. I mean, if AI is what people are going to say it is, that that it's going to be, those chips are needed. Of course, it played into Adobe. Not that they do the chips, but just anything AI.
I know
is hot right now. So.
AI, add it onto any name, Chipotle or Kava.
Well, I was going to say.
Kava.
Yeah.
Sorry.
It's actually not a chip company.
Kava
They're
AI.
not doing
Not
There
like
we
it
go.
needs any help juicing that stock.
Exactly.
Abigail, thank you so much. We so appreciate it. Chief Markets Correspondent Abigail Doolittle joining us. So that brings us to
Kava. Because of all the hot IPOs over the past year, AI firms and biotech startups and the like, none has popped on Wall Street quite like Kava Group. The restaurant chain, it's the Mediterranean Chipotle, its financial backers like to call it, soared more than 300% since the IPO back in June of 2023. That was a year ago. Now it's got a market cap of over $10 billion. Bailey Lipschultz is Bloomberg News Equities reporter. He joins us here in the Bloomberg Interactive Brokers studio. All right, I'm going to do some math here, Bailey. $10 billion market cap, 323 restaurants, beep, 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 beep. About $33 million per restaurant.
Could you do that again?
I'm no financial analyst, okay? I'm no financial analyst.
Please.
But I just copied that
Maybe
right
at
from
the
Bailey's
end.
article. He did the math. Is that valuation a bit rich to its peers?
According to some of the analysts, we had JP Morgan downgrade the stock a week and a half ago, saying that it is unprecedented to have a per restaurant valuation like that.
$33 million per restaurant.
Just for comparison, the gold standard in fast casual, Chipotle, the actual Chipotle Mexican grill, about $25 million. So this is Today, about per store. So about a factor of what? A third, 30% higher for a company that only has 300 and change.
What's the revenue per? Do we know revenue per store?
About $2.5 million
on
average
for Chipotle or for Kava?
For Kava.
$2.5 million. Okay, what about Chipotle?
Chipotle is actually kind of closer to that. They're closer to the $3 million mark. I thought it was going to be a lot higher.
Yeah, so did I.
But when you look at the story, so you look at Chipotle and you go back to when it went public, had a number of issues back in 2006. Then 2015, 2016, they really hit the gas pedal on expansion, had those issues with food safety, had a number of problems and headlines. It took them more than 2 years to recoup
I was
those
going to say, it was
losses.
a few years. It wasn't just like one little thing. Yeah.
And so that's the thing when I talk to people who are skeptical of Kava is they're talking about 1,000 stores within the next decade. How that growth works, how you can find and train employees, and how that expansion actually operates. While, again, when you look at where they're popular, Northeast California, it's people who can spend $14 on a bowl of falafel or land gyros.
Bailey, as part of the reporting on this, did you go to Kava?
I did not. I'm still mad. I still don't know how I didn't get to expense Kava.
Does it also speak to just $14? People want to partake in an IPO, and we just haven't had a lot of IPOs. Like, what is the thinking about why investors are pushing it up so much?
I think people like a growth story. So the idea that you have a restaurant company who is going to essentially 3x their footprint in the next 10 years, has pretty strong margins, has ability to capture kind of that brand mentality of the Mediterranean.
And people are really into that diet, that food, if you will.
And people also are bidding up stocks that are within the fast casual space. So you see Wingstop up quite a bit. McDonald's even has been knocking the ball off the cover in terms of stock performance. So when you look at where investors are putting cash to work, it does seem like they're buying brands they know. They're buying companies that you could make the argument if people are downshifting some of their spending instead of going out to eat, maybe you go to a Cava or a Chipotle. On the flip side, if you're a New York banker and $14 for a Mediterranean salad is really nothing bad.
I was just going to say, love me some McDonald's French fries or even a Happy Meal. Don't judge me. But the fast casual folks are calling and they're like, wait, I don't know that McDonald's is fast casual.
Yeah.
This is true. Oh, no, definitely not. I mean, you think about a Sweet Green as like a peer, Chipotle, you mentioned Shake Shack. Wingstop maybe is kind of a peer. You have it in the story as a valuation multiple peer.
Yeah, a better comp, just because, I mean, McDonald's chart actually is pretty ugly.
I'm not judging you. They're calling and saying,
But if you look at Wingstop stock, it's doubled in the last year. Yeah. It's up 200 and change in the last few years. So it's still kind of with that market penetration story, the idea that maybe people are going to be more willing to spend up for some food.
I am curious too, and I just want to pull it up here. Short position is 15% afloat. So people, because it's been such a tremendous run,
It's been pretty flat
consistent?
though. That's kind of been the.
So it hasn't changed.
It hasn't changed much in the last few months. That was one of the things we first looked at was, all right, well, $10 billion feels lofty for a company that still needs to grow quite a bit into that valuation, but it doesn't seem like shorts are betting against it. Even when I talk to someone who's taken a short position, the argument is it's still expensive and it still hasn't quite worked out. And if you're arguing for fundamentals to matter, as we've seen really over the last 3 years, the market can hold out longer than you can keep a short bet on.
All right, interesting.
Bailey, let's talk about share sales. I know it's something that we follow closely here at Bloomberg. And Carol, I do want to mention, you reminded me of this. Ron Shaich, who we've had on the program, founder of Panera, he is the 5th largest shareholder of Cava. And his stake, he's also the chairman of the board. He's got, about $500 million worth of Cava stock right now.
Yeah.
But there's been some share selling.
Yeah, we've seen some sales. Now I obviously can't pull up that BFW we were just talking about earlier. But we have seen a number of the larger shareholders lowering their positions. We saw, at least within some filings, going ahead and showing that insiders have sold $369 million worth of stock. So Artal is their largest shareholder. According to these filings, they sold about $262 million worth of stocks, 3 million shares underlying that. But Shaich, to your point, selling 1.23 million shares, $107 million of profit, which, again, if you're a fundamental analyst, though, it's not a bad payday when you're up 4x from IPO, and who knows how low you got in pre-IPO.
Well, probably some financial planning.
Yeah, well, listen, and a lot of these guys, he is someone who's played in the space. They tend to provide startup money, or they get in when a company's kind of developing who they are, their model, so early money, right, investor money, and then at some point you're like, okay, I'm done. That was my seed money, my venture money.
I'm going to go buy some Cava now.
A Cava.
A $14 bowl.
Cava.
Sorry. Have you tried it ever?
I had it. Me and my fiance split a falafel bowl last weekend.
Okay.
All right.
It's a little prep.
I mean, well,
so Carol asked me how it was, and I was like, yeah, I've been.
I mean, I'm also just like such a fan of halal street cart food here in New York. So it's like for $7, I can get really good, terrible for me food, or I can spend twice the price for something that's arguably worse, personally.
Yeah. All right. Well, anyway, it's certainly been on a tear, and some people are watching. I know, for many, many reasons.
Doesn't get any better than this.
Have a great weekend. Thank you. Bloomberg News equities reporter Bailey Lipschultz. Coming up next, we talk Spotify price hikes with our own Bloomberg News music and audio reporter. That is coming up on Bloomberg News This Week. Carol Massar, Tim Stanovic. This is Bloomberg.
Wall Street, we do check markets all day long here at Bloomberg. The Dow, the S&P, they're lower. NASDAQ back in the green now, up 6 points, up less than 0.1%. Meanwhile, the S&P 500 index remains lower by 0.1%, down 6 points. The Dow down 85, drop there of 0.2%. 10-year 4.20% with a 2-year 4.68%. Gold up 1.2%, 23.32 the ounce. West Texas Intermediate crude oil flat on the day right now at 78.61 a barrel. A renewed wave of anxiety is gripping global markets as concern over that political crisis in France deepens. Traders decided to take some risk off the table. French shares this week losing roughly $200 billion in value. That is about the size of Greece's economy. We are on track for a second week of gains for U.S. stocks. Big tech continues to outperform, but can the rally widen? That question for Quincy Crosby, Chief Global Strategist at LPL Financial.
The only thing that we've started to see with the mega tech is that the companies that are underneath that mega tech, the broadening out has happened there. So you got Broadcom, you had Oracle, Adobe had good numbers. But the fact is we haven't seen it spread out recently, to the banks, to industrials, even, stock specific in healthcare.
Quincy Crosby of LPL Financial, she touched on Adobe stocks surging after earnings, up now by 14.4%. Again, recapping, S&P down 6, down 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Do appreciate it. Lots of headlines about Spotify and its membership plans over the last week or so. Before that, Carol, last week Spotify said it would raise prices in the U.S. by $1 per month in July, so it brings its standard paid tier up to $11.99 a month. It increased the sub price last year to $10.99 a month. That was from $9.99 after not having touched its price for more than 10 years. So a couple price increases after a long time of not increasing the price. Now the company is introducing this new higher price premium plan. It's going to cost $5 more per month. Shareholders certainly cheered that news after our next guest reported it earlier this week. Ashley Carman is Bloomberg News music and audio reporter. She writes the Soundbite newsletter, which you can sign up for at Bloomberg.com. Ashley joins us from New York City today. Ashley, I want to talk about how much opportunity Spotify has to raise prices, because you can get what Spotify offers to a certain extent from other services. How sticky is it, according to your reporting?
So the music industry is certainly bullish on Spotify and believes that music is wildly underpriced at this point, regardless of the fact that the same music is basically available across many streaming services. My colleague Lucas Shaw has previously reported that Spotify, compared to video streaming services, is particularly sticky. And so I think they probably do have some room here to play around with price and likely will not see a ton of churn because of it.
It's really interesting for those folks who used to buy actually records and tapes and cassettes and all that stuff. Like I think about how much I use, access my music on my phone and so on and so forth, that you do wonder, is it kind of underpriced considering the money that we used to shell out for, buying individual, like I said, albums, if you will. Like you do wonder, is there kind of the analyst investments, argument that truly is the case, and this is why this makes sense?
This is what the music industry is saying, is they really believe that, yes, like to your point, and even now, a record of vinyl, which is growing in popularity again, actually, those could be $30, $40, and we're paying, $11, $12, whatever it might be, for access to the world's history of music, essentially. So the music industry really does believe that, yes, this is critically underpriced.
Okay, but Ashley, I got to tell you what is, I think, more valuable to me than the music that Spotify offers me every month, which I can get on Apple Music if I wanted to, is the data that it has about me and what it knows about what I like, what it knows about what I listen to, what it knows about the podcast that I listen to. In fact, I never see myself quitting Spotify as a result of that, because that to me is valuable. Am I weird, or is that kind of like what Spotify goes for with stickiness?
No, I think that's exactly the thing. I mean, some of us have been using Spotify for maybe 10 years now.
Yeah,
or
definitely
more,
me.
potentially.
Yeah.
Yeah. And so at that point, they have so much of our historical listening data. They have their Discover Weekly playlist. They know so much about us that to start over somewhere else and also have to create our playlist somewhere else, that's actually a pretty high bar for a lot of folks.
All right, so talk about, these increases in terms of prices for Spotify, because I was kind of blown away. I haven't looked at the stock in a little while, and it's up about 67% this year. I mean, the chart is so clean if you kind of, for the most part, go back to December, but really, in reality, if you go back to kind of late March, what it means for the company in terms of its balance sheet and how it moves the needle.
Yeah, so obviously this can translate to lots of new revenue with the price increases specifically, but I think what you're also seeing in the stock this year is the fact that Spotify has really just tightened its spending overall. Looking back even a couple of years ago, I mean, they were spending in podcasts like crazy. Investors did not like that. They wanted to see a much higher return on that investment. And really, what ultimately happened was Spotify just pared down its ambitions in podcasting quite a bit and now really doesn't have as much of an original content arm. You're seeing that. And also this reaction to Spotify introducing audiobooks to the platform, which I think investors are probably a little bit, I don't know if they're fully into it yet. I think they're probably a bit just waiting and watching to see kind of how user uptick happens on there and if people really convert, let's say, from Audible or just end up using the service for audiobooks as well.
I mean, I'm pretty delighted by it as a Spotify customer because books that I used to have to buy on a service such as Audible are available for free on the platform, Ashley. And I'm wondering how the agreement works with Spotify, how they're able to do that, because that just costs them more money without it costing me more money.
Totally. Yeah. So I think that this is a bit in the weeds, but actually there is kind of a separate story going on related to this right now in Spotify. And that is when Spotify introduced audiobooks to its service, it kept prices the same, to your point. Obviously, they're now increasing it, but broadly speaking, they kept it the same. And the music industry in March found out that because Spotify introduced these audiobooks and was introducing new plans, like an audiobook only plan and plans to introduce a music only plan in the US, Spotify is now classifying itself as a quote unquote bundle to the music industry. And what that essentially means is they pay a reduced royalty rate to songwriters. And Billboard estimates that because of this new classification that Spotify is claiming, over just the first year it's in place, Spotify will pay $150 million less in royalties to songwriters. So you could see how some of these pieces coming together might actually impact Spotify's bottom line more than seems obvious.
Interesting.
Okay, so stay tuned. Well, so depending on how that plays out, what are the implications for Spotify?
For that specific
complaint,
classification? Yeah, well, so one of the songwriter advocacy groups actually just filed a complaint with the Federal Trade Commission this week, claiming that that move was unlawful. They're also being sued separately by a group called the Mechanical Licensing Collective, which is also claiming that this is basically not allowed. So depending on how those two different litigations, I guess the complaint's now full-blown litigation, but the lawsuit at least, play out, it could affect how much Spotify is able to actually integrate audiobooks into its platform.
Ashley, we're jumping around a little bit, which is fine because I brought up the FTC complaint, but I want to go back to this premium plan that you wrote about this week. $5 more a month for Spotify premium, I guess you could call it. What does it actually offer people, and is it enough to get people who already paid $11 or $12 a month for Spotify to shell out $5 more a month?
So I think the headline feature that a lot of folks have been waiting for is this hi-fi, so high fidelity audio. It is already available on some competing streaming services like Apple Music and Tidal and Amazon Music. But Spotify announced it years ago and never launched it. And so it might finally be coming now. And then also some playlisting tools around sort of designing playlists without even your asking.
All right. I know I don't know a lot of things as most of my team or my family would remind me technically, but I did grow up with a lot of brothers and a lot of music in the house, and there were turntables that were floated up so that, vibrations didn't move them, and they were into speakers in a big way. Like, if you don't have a device that is capable of high fidelity, does that matter?
I mean, I think, I don't know if it matters. I guess it's just if you are a person who cares about the high fidelity audio and you do have the setup that would actually benefit from that.
Just curious. Like, yeah.
Was this the promise of Tidal years ago that they would? Is this the
Tidal,
equivalent?
yeah, Tidal definitely tried to make this kind of their big differentiator.
But so now Spotify caught up with what Tidal offered back then.
Seemingly they will, yes.
Okay.
I mean, this hasn't launched yet, but they did announce this years ago and never launched it. And I think, again, Amazon Music and Apple Music began launching it as well. So yeah, it's a bit of product parity here.
All I know is music for me, like I listen at home, on my way, like, I'm constantly tapping into this.
The discovery part, though, that Spotify, for me personally, with Discover Weekly, I don't know if even they still call it that, Ashley, or like your daily mix. I don't even know if they still call it that. But the fact that it can surface music to me that I wouldn't normally find is, I think, really valuable. We only have like 10 seconds left, but that's a big part of the equation here, no?
Yeah, and that's why I think this premium plan will include some playlisting features. Like, playlists have really become the thing that people know Spotify for, so that's a big part of it.
All right, great stuff. Hey, listen, thank you so much. Really appreciate it. Ashley Carman, music and audio reporter at Bloomberg News, joining us from New York City. I mean, you're not going anywhere, right?
I'm not going anywhere. I'm staying on Spotify. But coming up, U.S. Open golf update brought to you by Audi. Don't let anyone else drive off in the Audi model you've always wanted. Visit your local Audi dealer to get behind the wheel of yours today. But first, a check on the latest world and national news with Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Hey, Tim. Russian President Vladimir Putin is promising to immediately order a ceasefire in Ukraine and begin negotiations if Kyiv starts withdrawing troops from the 4 regions annexed by Moscow in 2022. Defense Secretary Lloyd Austin was asked about this at NATO headquarters today.
He is not in my view, not in a position to dictate to Ukraine what it must do to pursue peace.
Austin says Putin has lost, with some hundreds of thousands of troops wounded and killed. The Princess of Wales, who's not made any public appearances this year, will attend tomorrow's royal Trooping of the Colours ceremony. She says she's making good progress in her cancer treatment, but still has a few more months to go. Gun rights advocates have scored a big win with the Supreme Court. Today, the justices threw out a federal ban on bump stocks, the attachments that allow a semi-automatic rifle fire at speeds rivaling a machine gun. Dr. Harold Krent is a law professor at the Chicago Kent College of Law.
If we can ban machine guns because we don't think that's needed for hunting or any other kind of lawful use of a weapon, it sort of defies belief that 6 of our justices rejected an agency decision under the Trump administration that classifies these bump stocks as converting a shotgun into a machine gun.
Dr. Harold Krent spoke with Bloomberg. The ban was put in place after the 2017 Las Vegas concert massacre, when a man using bump stocks killed 60 people. The Justice Department says it has no plans to prosecute Attorney General Merrick Garland for contempt of Congress. He was referred to the department by the House after refusing to turn over audio of President Biden's interview in his classified documents case. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
3:40 on Wall Street. We do check markets all day long here at Bloomberg. We're looking at a mixed Friday right now. The Dow, the S&P lower, NASDAQ is higher, but let's head over to the first word breaking news desk for today's afternoon call. Here she is, Felice Morantz.
Good afternoon, Charlie. Stocks are indeed mixed, with the S&P 500 remaining somewhat under pressure throughout the day after University of Michigan sentiment data missed expectations. Industrial stocks were particularly hard hit. The Dow is down about 0.2%, S&P 500 cash down about 0.1%, NASDAQ 100 little changed, with the U.S. 10-year yield at about 4.2%. Small cap stocks down about 1.7%, while 9 of the 11 main S&P 500 sectors are trading lower, led by losses in industrials and materials, while tech and communication services are in the green. NASDAQ Biotech's down about 0.8%, transports down 1.1%, and semis little changed, while the VIX is higher by about 4.4%. Leaders in the S&P 500 include Adobe, Hasbro, and Gilead. Cruises are among the worst performers. Adobe posted its biggest gain in more than 4 years after the company projected strong sales. In other news, Charles Schwab is eyeing 20% growth after its investment management arm surpassed a $1.2 trillion milestone. And Larry Summers says Trump's tax ideas mean, quote, the mother of all stagflations. Wrapping things up, Barclays has suspended sponsorship of Live Nation festivals due to pro-Palestinian protests. Live from the First Word breaking news desk, I'm Felice Morantz. Charlie?
And we thank you very much, Felice. And to hear live breaking news over your Bloomberg, type Squawk SQUA on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
The funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. We've got, just under 18 minutes left in the trading session. Time flies.
It's Friday. It's July Friday, Carol. If you're just joining us.
I don't know what's been wrong with
If you're
me
just
this
joining
week.
us, Carol started the show by saying it was July 14th.
There's many things wrong.
That's okay.
Yeah, I know. Thank you for setting.
The
Tim
time.
always keeps me on the straight and narrow.
I guess that's the expression. We need Doug Krisner.
Where's Doug? Doug, where are you?
Where's
Dial
Doug?
in.
I'll tell you where
We'll
Doug
take
is.
the call.
Doug is relaxing because it's his Saturday.
He's like, I'm not playing with you knuckleheads. I'm
Can you
done.
imagine?
No.
Get a call from Chris.
You can call in, Chris. All right, let's get to it. Because lucky for us, if we don't have Doug Krisner, we do have Aaron Kennan, a favorite of our show, co-founder and CEO of Clear Harbor Asset Management. They've got about $1.5 billion in assets under management. He joins us from Stamford, Connecticut. How are you?
Doing great. Thanks for having me back, Carol.
Hey, nice to have you here. It's been an interesting week. What do we have? 4 days of back-to-back records on the S&P and the NASDAQ and NASDAQ 100. We've had a really reset when it comes to the U.S. Treasury rate environment. We've had a Fed meeting, lots of things going on. How are you kind of pulling it together and thinking, okay, here's the investment strategy for today and maybe the next, 6 months or so?
Well, we're always thinking about each individual client, what their short-term liquidity needs are, but really also, of course, what their long-term needs are in terms of their entire corpus and which asset classes really should be allocated within that context and which during this component of the market cycle should be overweight and underweight. And I would just argue that, I think we're at an interesting point for the overall bond market, particularly U.S. Treasuries and mortgage-backed securities. At the beginning of the year, the market was saying 6 rate cuts and the Fed was saying maybe 3. And now it seems like there's been some convergence there where the market and the Fed are now at sort of 1 to 2. And I think that bodes reasonably well for the bond market going forward. I think the Fed's clearly more poised to cut than raise. And if you look at inflation break-evens at now below 220 for the 10-year break-even this morning and 10-year Treasury yields at 420, that 200 basis point spread gives a bit of a margin of safety, if you will, for those who want to allocate and extend duration a bit on the fixed income front. And of course, equities are all over the map in terms of valuation. You have the
Wait, I want to go to equities in a moment, but I want to ask you about our Ira Jersey, who follows the rates market, reminding us that for 2 years we've had an inverted yield curve if you look at the 2s and 10s. So does that mean to you at some point, oh yeah, we're going to see a different cycle, we're going to see some kind of downturn, we're going to see some kind of recession? Or is it fair to say that we're still kind of, maybe it is different because we're still coming out of the pandemic, so much money's still around, and maybe it doesn't necessarily indicate that we have to have a downturn, but we do have to work through some of this excess liquidity that's been out there?
Yeah, it's a great question. I mean, we have recessions on average over the last 100 years, like once every 8 years. And I think the average economists today think that there's a 12.5% odd of a recession within the next 12 months, which suggests that overall 100-year average. I think recessions are historically very challenging to predict. They usually happen when there's an economic crash that comes out of left field. It could be due to something like COVID or the dot-com bubble or something tragic like 9/11. And so I think it's very hard to predict that. I would sort of say, though, that it's been surprising. We've gone more than 400 days with that inverted yield curve, as you mentioned, without having a recession. We've also had the leading economic indicator index way over the average after it peaks, which it did in December of 2022. 14 months after that peak, on average, we're in a recession. We're not in a recession right now, based on most metrics. And we've gone way over, of course, that 14-month period. And I think to your point about COVID, we had a huge gyration where demand for products rose significantly and demands for services collapsed as we went into COVID. As we came through and out of COVID, that all shifted. And I think the economic data was extraordinarily violent and made it very challenging for economists and market strategists to try to sort of read through the tea leaves as to whether or not we're going to recession or something else.
Well, if we were to go into recession, then what would you think would prompt it? There were some folks who were saying, well, the labor market does appear to be weaker than it seems, but what would you say would cause it?
Well, it's interesting, Tim. I don't think it's for example, market multiples or valuations. That is something that we're very mindful of. We want to be very careful to allocate to extraordinarily expensive our items within the marketplace, but that has not typically been a great barometer for the likelihood of recession. I mean, certainly a sharp rise in unemployment, weakness overall in the employment picture. If you look at the consumer, it is under some incremental stress right now. When you think about, sort of auto loans, delinquencies, you think about the rate at which credit card lines are charging. It's about 23% on a credit card right now. You look at the savings rate back below historical averages, and you look at the historical sort of mortgage rate today, incrementally weighing on those who do have a high interest-bearing mortgage. But as some data has shown recently, most people are still under that 4.5% mortgage rate. And so this monetary policy is really working with a significant lag, but we may finally be seeing that lag weigh in on the market. Not calling for a recession, but certainly there's indications that the consumer is on its heels, it's not on its toes, and maybe GDP is poised to decelerate on the margin here.
Yeah, and one thing, when we maybe start to figure out a narrative or trend that's going to stick, we are reminded that geopolitically stuff happens, like in elections. And I'm looking at our market right through, and we're still talking about anxiety in global markets about the political crisis in France following those parliamentary elections. So having said that, just got about 30 seconds, geopolitics still something you keep a very close eye on in terms of how it impacts the trade?
We certainly do, and historically it hasn't had a meaningful impact on the long-term sort of trends in the market, but we are at this point now where public debt levels are extraordinarily high, both here in the United States, in Japan, and now in Europe. And, we have a lot of uncertainty coming together on the political front. You mentioned Macron in France, and we have Scholz in Germany on his heels and with his party. We have Sunak with the Conservative Party calling for a snap election. And, of course, we have uncertainty here in the U.S. And we have the rise, I think all those sort of elections speak to the rise of populism. And when you have a resurgence in populism, you tend to have a challenge as it pertains to maintaining solid fiscal sanity within the public sector.
Aaron Kennan, thank you.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 7 minutes to go ahead of the closing bell. Stocks lower. The European Commission plans to allege that Apple stifles competition on its mobile app store. That, according to the FT, citing 3 people with close knowledge of the investigation. The Commission has determined, according to the FT, that Apple is not meeting obligations to let app developers steer users to offers outside its app store without imposing fees on them. Apple shares right now lower by 0.9%. Apple is on track for a winning week. Tesla investors reapproved Elon Musk's compensation and cleared the company, moving its legal home to Texas, offering votes of confidence in the CEO despite a sales slump and a falling stock price. Tasha Kenny is Director of Investment at ARK Investment Management.
It's positive that, we saw investors considering the proxy and putting their own votes in, voting for themselves. When we look at Tesla, we certainly want Elon Musk to be at the helm, especially when you consider the transition to fully autonomous driving, which is what we think will drive the majority of the value of the company over the next 5 years.
Tasha Kenny of ARK interviewed this morning on Bloomberg Television. Tesla shares trading lower today, along with the rest of the market, down now by about 2.3%. RH shares are plunging after earnings. The furniture retailer reported a heavier than expected first quarter loss. KeyBank Capital Markets says the results did not meet expectations, noting softening demand in the latter part of the quarter. Today we had shares of RH, Restoration Hardware. They are plunging now by 16.9%. Those are our top company stories, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody, under 5 minutes left to go to wrap up the Friday trade and wrap up the week overall. We're going to head over to our TV colleagues in just a moment. Having said that, we've got an upbeat story. No, we don't.
Not, as they would say. It's an exclusive here. It's the big take. I encourage everybody to check it out. And it's about everybody, yes, getting sick more often. Argentina right now is battling its worst ever dengue outbreak. Japan is seeing a mysterious surge in strep. Measles is making a comeback in more than 20 American states, the UK and parts of Europe. Carol, globally, 7.5 million people were newly diagnosed with TB in 2022. It's the worst year on record since the WHO started global TB monitoring in the mid-1990s.
We warned you. At least 13 communicable diseases, from the common cold to measles and TB, tuberculosis, are surging past their pre-pandemic levels in many regions, often by significant margins, according to an analysis by Bloomberg News and London-based disease forecasting firm Airfinity Limited. It's interesting because it says the resulting research, it was based on data collected from more than 60 organizations and public health agencies, shows that 44 countries and territories have reported at least one infectious disease resurgence that's at least 10 times worse than pre-pandemic, the baseline from the pre-pandemic era. And they're trying to figure out exactly what's going on.
Okay, well, bad news if you're looking for a why here or a how, because the post-COVID global surge of illnesses, we're not talking just about viruses, we're talking bacteria as well, common and historically rare. It's a mystery that researchers and scientists are still trying to definitively explain. The way COVID lockdown shifted baseline immunities is a piece of that puzzle, as is the pandemic's hit to overall vaccine administration and compliance. Climate change could also be an issue.
Because that's interesting. Climate change, rising social inequality, and wrung out healthcare services are contributing in ways that are hard to measure, which is like, wait, what? Right?
Yeah, I think there are a lot of theories out there about why this is happening. We certainly saw it happen post-pandemic when we weren't sick for so long because we weren't doing anything.
Right.
You came back to the office, everybody came back, and then you're like sick again.
No, and
I just thought it was because I had young kids.
Well, and it's like they talk about different things, different vaccines that were maybe put off. Like you do wonder about, all of these things. But influenza cases in the United States alone, folks, have jumped about 40% in the 2 post-COVID flu seasons.
Whooping cough, pertussis climbed by 45 times in China in the first 4 months compared with last year.
It's a lot. It's a lot. Anyway, we're going to try and get more upbeat. We're going to try and find some levity. We're heading over to our TV colleagues. The closing bell. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic and Alex Steele taking you through the Closing Bell, a global simulcast up ahead here of today's market moves with Scarlett Fu here in the TV studio, Carol Masser and Tim Stenedick in the radio booth as we welcome our audiences across all of our Bloomberg platforms. Carol Masser here on a somewhat sleepy Friday afternoon.
I know, I'm calling it a meh Friday, right, in terms of the market trade, but we've had quite the week. Meh? It's a thing.
Okay. Technical term, I believe.
I mean, what? We've had record runs on the equity side of things up to today. Maybe on the NASDAQ we might see it again, but we've also seen a big rates coming down. We had consumer sentiment, some weakness again today, pushing pressure on yields even lower. So, yeah. We're taking a breather ahead of the weekend.
It was interesting to see the narrative kind of emerge overnight about concern about what's happening in France, geopolitical concerns in Europe with those parliamentary elections. But it does seem investors are a little on edge, but still today's move's kind of muted.
I wouldn't say that they're on edge, given that the S&P 500 is pretty much still holding at its record high. In fact, if anything, I'm kind of impressed with how resilient it is, given a lot of the headlines and the talk about all this uncertainty. You still have everything kind of valued where they were when everyone was excited.
It definitely feels it's more truncated, right? Like the CAC 40, to Tim's point, erased gains for the year. It got hit pretty hard, but that's very much somewhat concentrated on that level. What did participate, though, is the buying into the Treasury curve, right? Like that's your safe haven. That's what you're getting.
Yeah, obviously you saw the strength there in treasuries with yields dropping here, strength in the dollar here. The VIX elevated slightly, but still below that 13 level. And as Carol Masser was just alluding to, equities taking a little bit of a breather after hitting record highs, at least for the S&P and NASDAQ in the first 4 trading days of the week. Looks like we're going to get a little bit of a pullback, at least on the S&P. Right now, the S&P 500 is down about 1 point. Now, it takes a while for these numbers to settle, but that would basically make it unchanged on the day. Keep an eye on the screen because that could flip at any second. The Dow Jones Industrial Average will definitely close a lower here on the day, down about 0.1% here on the day, though the NASDAQ Composite holding into the green here. You got a nice bid today on the back of some of those tech stocks, up 0.1%. The NASDAQ 100 up 0.4%, but the big laggards on the day were in the industrial and cyclical space. Transport's down 1%. The Russell 2000 down 1.6.
Like I said, meh, at least on the equity side of things. All right, let's get to some of the individual. Actually, we're going to talk about the S&P 500. You will see, in terms of the tone, guys, most of the names lower in today's session. 370 to the downside, Scarlett. 131 actually gaining some ground.
All right, and of course, Romaine mentioned the industrials. They are the leading laggards here in the S&P 500, down more than 1%. You have materials and energy, so the commodity-linked names also on the weak side, losing 0.8 and 0.9%. The green slices of that pie, communication services, tech, and consumer staples, although consumer staples basically unchanged. So we're really talking about tech and communication services.
Really random, but I would love a slice of pie right now. All right, let's get to Adobe. I'm kind of hungry.
It would help you not be meh.
No, exactly. All right, Adobe, certainly an outperformer in today's session. #1 gainer in the S&P 500 and the NASDAQ 100, finishing just off its highs, guys, but just below a 15% gain in today's session, up the most since March of 2020. The company, we know the deal, right? We were breaking it down last night. Strong future sales for its creative products, suggesting customers are adopting the company's new AI-based tools. So pretty exciting, investors moving into that way in a big way. Let's get to Netflix, an outperformer, up about 2.5% in today's session, highest since about November of 2021. It is up now about 40% year to date. KeyBank Capital Markets out with a report saying his firm's latest media survey showed increasing usage of the Netflix service by its members, always important. Reiterated his overweight or buy on the stock, upped his price target to $707 a share from $705. So a slight tweaking, if you will. Stock closing at about 669 and change
today.
Can I
say, you know what we've noticed at home? That anytime you log into Netflix now, we pay the higher tier to not get the ads, but every time we log in, they give us a pop-up asking if we want to go down to the ad tier.
Really?
Yeah, which I think is interesting. So
that is really weird.
I don't know why they're trying to push us there. Maybe it's more economical.
Because they probably want to show that their ads are worthy of something. That people are actually watching the ads.
They want to show growth in that category.
Yeah.
Oh, okay.
That's funny.
It's a move, yeah.
Great question. Nice little conversation there. All right, let's get to Hasbro. Sorry.
Is she being facetious?
I'm still looking at.
No,
I'm still
Has
thinking
she
about.
started drinking early, Tim?
I don't know what's going on.
Oh, that were the case. Hasbro up about 6% in today's session. Number 2 gainer in the S&P 500. B of A analysts coming out raising the recommendation on the toy company to buy from neutral. So this one certainly an outperformer. All right, over to Mr. Stanovic.
I want more gainers, Carol.
Nope, I'm done.
Okay. All right. Do you want to start with shares
It's
of
a
Apple?
3-gainer type
Worth
of
checking
day.
in on what happened this week, okay? Down by 0.8% today. But the reason I'm talking about it is because there was a bit of news from the European Commission that they plan to, well, it's from Financial Times, I should say. The European Commission plans to allege that Apple stifles competition on its mobile app store, citing 3 people with close knowledge of the investigation. The thing about Apple is the moves from the post that article were not actually big. They were pretty muted, so nothing big to report there. The bigger move with Apple is what happened this week. Shares up around 8% so far this week after the WWDC conference on Monday, where Apple unveiled that new the new AI features for its new operating system. Apple shares up close to 30% from their April lows, so it's been quite a big rebound in a very short period of time. Do you want to talk RH, the company formerly known as Restoration Hardware, having its worst single day going back 4 years to 2020, down 17%. Shares plunged after the company reported a heavier than expected first quarter loss. Said first quarter adjusted loss per share was 40 cents. Estimates were for 9.2 cents per share. The guidance for its adjusted operating margin also came in quite a bit below estimates. Price targets at Wedbush, Bank of America as well. And then the cruise operators in the S&P 500, Norwegian and Carnival Cruise were at the bottom. It was interesting. There was just a note out from Bank of America today that said that recent data showed modestly softer pricing. Andrew Dodora over at B of A wrote a note that cruise prices in early June were modestly softer in ocean markets relative to early May. It's why we saw a sell-off. Carnival down 7%, Norwegian down 7.5%. Truist said that potential restrictions on islands in Greece could be an issue, but also said that the stock sell-off seemed excessive. But this was surprising to me that note would prompt a sell-off like this.
But you know what outperformed? Alaskan Cruise. The pricing for Alaskan Cruise actually continued to outperform. So they're going, it's just being a little bit more
That's an older
discerning.
cohort, though. That's the ones who
That's
go on
right,
the Alaska
yes.
Cruise, right?
Who have the money to do this stuff.
And the time.
and the time to do that. All right, let's get to the bond market here, guys, because we did see a lot of buying come in pretty much across the curve. You could say some of it's going to be Fed-related. Some of it will be safe haven as flows from Europe and sort of the anxiety there. But yields were down about 22 basis points on the week. That's a pretty chunky move there, guys, on the 10-year.
Yeah,
Massive.
Pretty impressive. All right, let's get to something that's really important. I'm not sure it was discussed at the Fed meeting, probably not, but shorts at the office, yes? Show of hands?
Jay Powell wearing shorts at the
Especially
office.
for
wearing
guys.
them? Like wearing
for
shorts at the
guys.
office.
Shorts, go anywhere you want. Shorts, yes or no?
What stock are we shorting? I'm confused.
No,
Nice,
I'm
Romaine.
talking about,
Always brings it
Bermuda,
back.
cargo, those
No.
kind of shorts. Apparently, if you're on the West Coast, it's kind of normal, but if you're here in the Northeast...
They also wear hoodies.
Can I just say, I don't want to put Tim on blast here, but every day,
I'm ready.
Do I have to turn this car around?
every day I see Tim walking around in his shorts.
I know.
So Tim, you should have raised your hand there.
Yeah.
Okay, but to be fair, he changes. He bikes in and then he changes. I got you, Tim.
That's the context I
Hand
need,
the camera
Alex.
down.
Thank
I
you.
want to know.
The reason we're talking about this is because one of the most read stories on the terminal today is from Sarah Green Carmichael. She's the Bloomberg opinion contributor. She writes about workplaces. She writes about work culture. And she talks about the changing idea of what is acceptable and what's not acceptable at the office. And I got to tell you guys, some people saying shorts are okay.
No. Oh, if you work in a gym, yeah.
Or if you work at home, you can wear shorts.
Or at home, right.
And that's what we saw throughout the pandemic.
Exactly.
In fact, there was another great story this week that Wells Fargo, I mean, this part isn't great, but it fired more than a dozen employees last month after investigating claims that they were faking work. There are allegations of simulation of keyboard activity. So here's where life imitates art, because in The Simpsons, in season 7, there was an episode where Homer gains a ton of weight so he can qualify for disability status and work from home status, and he uses a drinking bird to tap the Y key on his keyboard because he's a nuclear power inspector, and that's what he needed to do, just tap Y. He also used the end of a broomstick to do the same thing while watching television. Again, he gained a lot of weight, so he was wearing a muumuu and sitting on the couch watching TV.
Okay, guys, for context, Scarlett has been working on this for like 24 hours, okay? Because when the story came out yesterday. She's like, guys, we got to do it. She found the graphic. She found the GIF. She
Went
made it
home
all
and watched
happen.
The Simpsons again.
I was
All of
joking with her
season
before
7.
the show. I was like, you spent all day on this, haven't you? She's like, totally.
What I love about this too, and by the way, great video there, is just how more sophisticated it's got. I mean, Wells Fargo didn't say exactly what they're using, but I've seen these devices. You can buy them on Amazon or anywhere else
Not
now.
the drinking
so
bird.
it's more sophisticated. So you can just log into your Zoom or your Microsoft Teams or whatever, and it makes you look like you're just staring at the screen, working
But
away.
the drinking bird.
We got you. We got you. I got you. We just need one for the mouse.
goodness.
Hit the mouse. Hit the mouse. There
All right,
you go.
no shorts and no mouse movers. That's, I guess, the bottom line. All right, guys, have a great weekend, a safe weekend. Enjoy. That will do it for our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. It is the closing bell. We will see you all on Monday.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
We're not going to talk about shorts anymore, but we are going to talk about. I know. All right, I go there. It's like, remember when things used to slow down in the summer? It feels like, alas, no more.
I know. Geopolitics front and center this week, courtesy of ongoing global elections, or in the case of Europe, parliamentary elections. That G7 meeting, Carol, reminded all of us about the global leaders that are increasingly facing challenges at home and the way constituents push back, and increasingly in parts of the world are embracing populism.
Yeah, we've been talking about this a lot this week. Also, of course, the Fed meeting, the inflation watch, with the weekly roundup ahead of Bloomberg Wall Street Week, which is coming your way at 6 p.m. Wall Street time on Bloomberg Radio and TV. David Weston joining us here in studio. Some really big global issues. And I feel like a lot of our market guests have increasingly brought up geopolitics in a big way.
I don't want to be flip, but you can pull it all together. You can pull shorts together with politics, together with populism. It's called John Fetterman.
Yeah,
you didn't ask about the floor of the U.S. Senate, right?
Well done.
Remember they had to change the rules on how you dress on the floor of the Senate because he couldn't vote on the floor of the Senate because he only wears shorts. So it all comes together, Carol.
See, it does come down to shorts. All right, so let's go to geopolitics. You guys were thinking about it in a big way, obviously.
Yeah, absolutely. We spent some time with Larry Summers in the wake, particularly of those European elections that we had, as you know, on Sunday, and what that says not just about Europe, but about the United States potentially as well. And he's very concerned about what he thinks of as, he would describe it as a right-wing nationalist populist sentiment that's sort of sweeping a lot of the world, certainly the northern, as we call it, part of the world. And he thinks that has some really bad consequences for economics. But that pales in comparison with what he has to say about Donald Trump's theories of economics.
Well, let's go there.
Well, maybe.
My bad.
No, I don't think so. No, but what it was you remember yesterday, the former president went up to Capitol Hill, and there were various accounts of what he had to say. And one of the things he speculated about, suggested, was maybe we can do away with the income tax altogether and replace it with tariffs, which set off Larry Summers rather strongly. So this is part of what Larry had to say.
Replacing the income tax with revenue with tariff would be the worst macroeconomic policy proposal in U.S. history. To create a downward spiral as much higher prices for everything we import means consumers have less to spend on everything else, create worldwide economic warfare as the rest of the world responds. This is a prescription for the mother of all stagflations.
Yeah, so obviously it's pretty
He's
extreme
a Democrat.
language. He does tend to although he points out in
maybe
the
that's not
interview,
fair.
you're absolutely is. He served in Democratic, although he says he's not been shy about criticizing the Biden administration and its economic policy endpoints. And he says, we should all really take a hard look at it. But what he really does is he invokes what macroeconomists always do when they really go to the extreme, and that's Smoot-Hawley. You remember the tariffs in the 30s that triggered perhaps global depression. And he says, look, Smoot-Hawley was 0.6% of GDP. If you're really going to do this, it would be at least 6 times that. And he said the consequences for the United States economy and the world are really just unimaginable.
It's pretty remarkable to hear a theory thrown out like this, that replacing an income tax with tariff revenue given who tariffs end up hitting the hardest versus who income tax hits the hardest. And it doesn't really align with the idea of populism.
Well, it is a strange thought. This has been around a while, actually, for Donald Trump. He thinks, basically, we make money off of tariffs. And he never quite addresses where the money comes from. Right. China does not pay the money in tariffs. Yeah, exactly. Consumers are people who are buying goods.
Companies pass it along ultimately to consumers.
So it's a wealth transfer, essentially, from the American public, and particularly some of the American public can't afford it because it tends to be regressive.
It's inflationary, too.
Totally inflationary, exactly right. But that goes along with so many other things. I mean, curbing immigration is inflationary because it drives up labor. I mean, doing away with globalization is inflationary. There's all sorts of things that are inflationary, and that's what Trump is being accused of right now.
Well, you know, it kind of goes back to big bad China, and I feel like pushed back so much against. But I mean, you know, former President Donald Trump isn't the only one who's talked about tariffs. Like, we see it increasingly too in the Biden administration, right? Against different things. So it's like it has become this big policy.
Biden administration did not do away with the Trump tariffs at all. If anything, they drove it up further. And listen, populism is not uniquely right of center by any means. Right. There's left populism, and certainly the Democratic Party has never been big fans of free trade or globalism, but they really want to protect jobs no matter what.
You had the Rockefeller International Chairman on also this week, who's got a book out, What Went Wrong with Capitalism. And I feel like we are having some really big conversations about that, public markets and who really benefited, who got the wealth, you know, that we've seen that's been created in the equity market, certainly. And I do think about, like, where did capitalism go wrong? Yeah, and how that plays into politics.
Yeah, this is Rasheer Sharma's new book. And basically he thinks it's government intervention in the economy. Yeah. Interestingly, he takes it all the way back to John F. Kennedy. He said before that it was thought that you cut taxes when you were having a recession or there was a slowdown. Kennedy, he says, was the first president to cut taxes to try to spur growth when there was not a recession or a slowdown. And then it got worse. And he really takes on Ronald Reagan also, because we think of Ronald Reagan as smaller government. Not true. Ronald Reagan kept the government or grew it more. The big change from Reagan was he borrowed a lot more. And so what we've had is more and more borrowing, more and more spending. Every time there's a crisis, we have to go in and bail people out, no matter what happens. And that's gotten bigger and bigger and bigger, and people just expect to be bailed out.
Speaking of populism, how are you watching what's happened over in Europe over the last week when it comes to the parliamentary elections? And especially the snap election called by French President Emmanuel Macron.
Yeah, by the way, the second snap election we've had in Europe right in the last...
It's nuts, right?
Yeah, I know. Well, we had on actually Stephanie Flanders, our colleague from over in London, about this. And there's, as you know, a lot of concern. You've seen what's happened to the French markets. I mean, it really
erasing all gains on the CAC for the year.
Yeah, exactly. And because she said this may be the first time ever. You know, they have a two-stage set of elections over there. She said it may be the first time ever when essentially the left all gets together, the right all gets together, and you have a fairly extreme left versus a fairly extreme right in the elections, and Macron gets dropped out because his party's not doing very well in the center. And what that does potentially for economic policy and for bonds, French bonds, and the stock market is not attractive, and particularly for foreign investment. One of the things we talked to her about is, does this help foreign direct investment? She said, absolutely not.
Right. Well, the instability, you know, I was thinking about the G7, just like the leaders that were there and that were all facing kind of difficult kind of elections or political climates back home. And it was just kind of an interesting thought of just kind of how do they be unified, think about policy that's important for the world, yet they've got to kind of then come back home.
But there are so many ironies in this, if you think about it. We have Rishi Sunak, who looks like he's likely to lose the election, right? Yeah. So Labour's going to come in, but they're actually more stable and more conservative in many respects than what other people have been. You've got Olaf Scholz, who's really been dealt a blow. We've talked about Macron. Who's the one who's really done well? Somebody we used to think was an extremist, that's Meloni.
Which is kind of crazy,
She's the voice of reason right now, and she actually has been ratified. I mean, who would have thought the world's just sort of turned upside down? She's the reasonable one.
One more thought. Your F block.
Oh, you want
I don't want you to give it away, but you talk about pivots.
Oh boy, you know everything, don't you? Yeah,
well,
we do talk.
You have a good team that shares with us.
A lot of pivots. A lot of pivots this week. A lot of people changing money, including, for example, Rishi Sunak, who, as you know, came back quickly from the D-Day and said, "Boy, that was the worst mistake I ever made. That was really a mistake. I wouldn't have done that." You had Benny Gantz leave the cabinet in Israel. You had a series of these, and of course, the big one of all, Sherry Redstone.
Yeah.
Never mind. I don't think I want to sell the company ever. And we've sort of pay it off with, this is not the first time Paramount's been through this. There's a long history with Paramount having troubles. So that is our one more thought.
That's why we love Wall Street Week. Really around the world and just thinking about it all. David, thank you so much.
Thank you.
Really appreciate it. The host of Bloomberg Wall Street Week, David Weston. It's coming your way at 6 p.m. Wall Street time on Bloomberg Radio and Bloomberg Television.
Hey, taking a look at how the markets closed, it was a mad day, as you described it, Carol.
I'm done.
The S&P 500.
I'm done with the market.
Pretty much flat. We did see some volatility in Europe, but
We
the
did.
U.S. closed down just fractionally on the S&P. The Dow down 0.1%, the NASDAQ higher by 0.1%.
We have a great guest coming up, Sarah Kate Ellis, President and Chief Executive Officer of GLAD. That in a moment.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. NASDAQ ends the week at a record 2 winning weeks in a row for the S&P 500 index this week. The S&P up by 1.6%. Today, however, a down session, at least for the Dow and the S&P. S&P dropped 2 points, finishing the week. Heading into the weekend, 54.31. Drop today of less than 0.1%. The Dow down 57, a decline of just under 0.2%. NASDAQ up 21, a gain of 0.1%. 10-year yield 4.21% with a 2-year that's yielding 4.70%. Gold up 1.2%, 23.31 the ounce on the precious metal. While West Texas Intermediate crude now at 78.38 a barrel, lower today by 0.1%. So again, NASDAQ at a record. What a week for Apple. Apple this week up by 7.9%. Apple had a $230 billion week. Apple shares today, however, did decline. Apple was down by 0.8%. The European Commission plans to allege that Apple stifles competition on its mobile app store. This according to the Financial Times, citing sources. Recapping, NASDAQ at a record. S&P lower, little change today, down less than 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Well, June is Pride Month, and all this month, Bloomberg Business Week will feature voices on topics related to equality. And to that end, Carol, we've got a great guest with us. Sarah Kate Ellis is president and CEO of the Gay and Lesbian Alliance Against Defamation, more commonly known as GLAAD. GLAAD describes itself as a, quote, nonprofit organization focused on LGBTQ advocacy and cultural change. Sarah Kate joins us from New York.
Sarah Kate, so great to have you here with us. One of the things I wanted to kind of kick off with, you've been in this position for 10 years, and I am curious, you know, what you have seen in terms of the hope, the disappointments, the enlightenments, the reality, in terms of acknowledgement and acceptance of the LGBTQ community. Because like most paths, it's never a straight line up or down.
Well, thank you for having me. Happy Pride. And that's a great question. It has been a roller coaster ride for the past 10 years. Before I started, we were headed into, and really did have the winds at our back at that point on marriage equality. And then we saw a real sharp backlash to that. So what we do at GLAAD is we do an annual KPI or measurement tool that we have called Exhilarating Acceptance. And it's a piece of research that measures culture and society to understand how accepting or not accepting it is for LGBTQ people in America. And what we've seen is that it's moved, once we passed marriage equality, we really saw a jump in acceptance in America. But then once we saw the 2016 election, we saw it dip down, acceptance for LGBTQ Americans. And ever since, we've seen it continually dip down as opposed to increase. However, what we haven't seen change and has stayed the same and is incredibly powerful for the past 10 years is that over 90% of Americans believe in equality and acceptance for the LGBTQ community. So we haven't seen that ebb flow, but we have seen culture ebb and flow over the past 10 years.
Sarah Kate, are you surprised that it hasn't been more linear?
I think, you know, honestly, after marriage equality, we really felt like, wow, we're making so much progress. The wind is at our backs, like I said. So it was shocking, honestly. But when you look at change in the trajectory and over long periods of time, it does ebb and flow. So I shouldn't have been surprised, but I really got caught up, honestly, in the power of progress that was happening at that time. And it was palpable in the culture, acceptance for the LGBTQ community. And my wife and I were able to get married. Mm-hmm. Our kids were at our wedding, you know, so it was like, it felt so good, like felt as though we were finally making headway. And we have made tremendous headway, but we have seen a backlash.
All right, so we have made headway, as you said, 90% of Americans' acceptance of the LGBTQ community. Why then, and you shared this statistics with a statistic with our producer, Paul Brennan, why are then we seeing 500 anti-LGBTQ bills introduced in 2024 if there's such a high acceptance level? I mean, I think about all the political polling. There's nothing, it feels like, that's 90%, and yet there's all this anti-LGBTQ bills being introduced. Why is that?
Well, you know, I think it's the continued disconnect between a handful of politicians and the American will and want, right? It's not, a lot of politicians today don't actually stand up for the majority of Americans and where they see America going. They're really, so this is a handful of politicians who are vehemently anti-LGBTQ, and these bills have been sweeping across America. Now, the great news is that I think out of the 537 have passed, which is not a lot, unless you live in that state, and then it's life-changing for you. But the damage is done when they're proposed, and that's why we're seeing the backslide in acceptance, because these bills are defining who we are as an LGBTQ community, because they're being talked about in the news media by anti-LGBTQ politicians. And they're especially targeting the transgender and gender nonconforming communities. And that's super dangerous because it's a small community within our community. They don't have a big voice. And that's why so many of us in the community are using, whenever we get a chance to talk about it, are talking about the trans and gender nonconforming community, because they've been politically used by anti-LGBTQ political activists.
Sarah Kay, one thing that's been really surprising to me, and we're Bloomberg, so we go, companies is the, and economics and business is the lens that we look through so frequently, is what's happened with companies that seemed like they were, they had fully accepted the idea of selling pride merchandise. I'm talking about Target, for example. It's now walking this tightrope because of fear they could face backlash like they did last year. Bud Light, I mean, we don't even have to rehash what happened there. That pushback was so surprising to me. What's going on in the corporate world right now from your view?
So there are, thank you for bringing this up, because I think there's a lot of false narratives around this. So I want to say that a couple of things. One is that what I've seen out of last year, yes, Bud Light, and Target were targeted by a handful of anti-LGBTQ activists that did an outsized social media campaign, and it did cause it caused some issues in the marketplace. Any CEO I talk to, and if you look at the latest Gravity research, the majority of corporate executives and Fortune 500 leaders are not backing down from their pride strategy, or what they are doing, and this is something that we've always asked for, and Target is doing this, is actually making it Pride 365, and not putting all their eggs in one pride basket, so to speak. Brands are really stepping up. They're not stepping down. And I'll tell you why. The reason is because CEOs and boards know that 30% of Gen Z are LGBTQ and 80% are allies. And they're not just allies for the sake of allies. They are very active allies. And so the future generation of employees and of consumers are highly attuned to the LGBTQ community. And in order to appeal to them, you have to stand up for the community. So we work with over 200 brands at GLAAD, and none of them have been backing down. So I think that there was a lot of headlines at that moment in time, but nobody really dug into the story. And when you look at the story, we haven't seen a movement from Fortune 500 companies.
One thing I wanted to ask you, it's like, we do months, right, to celebrate different parts of our community. And I kind of am with you that I feel like it's got to be embedded, intrinsic. It's got to be 365 days a year, 24 hours a day. Like our thinking, it's not just we did a day, a month, and we've solved our problems, or now everybody understands. It's really so much more than that. Fair?
Definitely. Absolutely. I think we can have days, weeks, months, whatever it is, because we're talking about marginalized communities. The reason we dedicate some time to these folks is because they have unequally been left out of conversations. And so we're trying to bring their voice to the table in various different ways. And the true authentic way to do that, like you said, is by incorporating, whether it be women or LGBTQ people or people of color, 365 days in every facet of your business. And that's the future of this country and the future of business.
Well said, well said. We're going to continue the conversation with Sarah Kate Ellis, President and CEO of GLAAD, Gay and Lesbian Alliance Against Defamation. She's joining us from New York. We'll get back to her in just a moment.
Hey, quick reminder on today's trade. For the day, the Dow fell just fractionally, while the S&P 500 barely moved lower. The NASDAQ was higher by 0.1%. David Weston reminding us to look at the week overall, Carol.
I know.
The NASDAQ higher by 3.2%.
He schooled me. I love that.
And the S&P 500 higher by 1.6%.
Just a math Friday.
So some pretty remarkable moves on the week, even though today's trade was a little light.
All right, really some interesting stuff. Coming up, a U.S. Open golf update brought to you by Audi. Don't let anyone else drive off in the Audi model you've always wanted. Visit your local Audi dealer to get behind the wheel of yours today. First up, though, now, let's get a check on the latest world and national news. Nancy Lyons in the Bloomberg 99.1 newsroom in the nation's capital. Nancy.
Thanks, Carol. The Supreme Court has dealt a fresh blow to efforts to regulate firearms. The justices have thrown out the federal ban on bump stocks, the rapid-fire attachment for semi-automatic rifles that was put in place during the Trump administration. This happened after the Las Vegas concert massacre. Bloomberg's June Grasso reports this was a split decision.
Here you have 6-3 down ideological lines with the three liberals in dissent. And I'm keeping track of this. This is the fourth 6-3 decision of the term. And I can expect, and you can expect, that in the next few weeks, there are going to be a lot more 6-3 decisions that we see.
Again, Bloomberg's June Grasso. Michael Bloomberg donates to groups that support gun control. He's the founder and majority owner of Bloomberg LP. Today, crews began the demolition of a building at Marjorie Stoneman Douglas High School in Parkland, Florida. The building was the site of a Valentine's Day massacre in 2018 when 17 students and staff were killed by gunman Nicholas Cruz. South Florida is still dealing with life-threatening flooding after getting 1 to 2 feet of rain over the past 48 hours. This resident says his entire neighborhood has been impacted.
It was just coming up to the house. We were on high ground, but the other houses are just destroyed around here.
The flood watch continues throughout today in South Florida. Milwaukee's Mayor Cavalier Johnson is defending his city after Donald Trump reportedly said during meetings yesterday with House Republicans that the city was horrible and overrun with crime. Johnson's response?
Well, Donald Trump was talking about things that he thinks are horrible. All of us lived through his presidency, so right back at you, buddy. I'd say that.
Johnson called it unhinged. Trump would diss the city that will be hosting the Republican National Convention. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
4:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, they finished today in the red. An up week. NASDAQ at a record on the week. S&P 500 index this week advanced by just about 1.5%. Today, the S&P was down 2 points, a little changed. 54.31, down less than 0.1%. Dow Industrials down 57, a decline there of 0.2%. NASDAQ again had a record up 21, advancing today by 0.1%. A renewed wave of anxiety did grip global markets as concern over that political crisis in France deepened. 10-year yield 4.21% right now, with a 2-year 4.70%. Gold up 1.2%, 23.32 the ounce, and West Texas Intermediate crude down 0.2%, 78.42 for a barrel of WTI. As for the rate cut environment, Aaron Kennan is CEO at Clear Harbor Asset Management, and he was a guest right here on Bloomberg Business Week.
You know, at the beginning of the year, the market was saying 6 rate cuts, and the Fed was saying maybe 3, and now it seems like there's been some convergence there, where the market and the Fed are now at sort of 1 to 2.
Aaron Kennan of Clear Harbor Asset Management. Winners and losers in the stock market today. On the upside, Adobe surging 14.5% after earnings. On the downside after earnings, RH, Restoration Hardware, lower today by 17.1%. Again, recapping, winning week for the S&P, record for NASDAQ. S&P today down less than 0.1%, little change. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stanovic live here on Bloomberg Business Week. We want to get back to our guest. We're talking with Sarah Kate Ellis. She is President and Chief Executive Officer of the Gay and Lesbian Alliance Against Defamation, more commonly known as GLAAD, still with us right here in New York City. Sarah Kate, one of the things that Tim and I wanted to talk to you about, and we kind of went back, harkened to a conversation we had with our own Michael McKee, who follows policy, economics on a global scale, but how media has amplified the pain of inflation. And it plays out in kind of political polling, if you will, that people just feel so bad about everything, but it kind of exacerbates things. You have certainly, played a role in media in terms of for the LGBTQ community and being aware of it. And I am curious how media has either helped or hurt in terms of acceptance and understanding by the broader public.
A media advocacy organization. We now refer to ourselves as a culture change because media is everywhere, right? And people have platforms that have never had platforms before. And I think it is, it's both a curse and a blessing. We've seen media really accelerate acceptance for the LGBTQ community. President Biden once said that Will and Grace did more for marriage equality than anything else. And I think
do you agree with that?
I think in terms of when you're thinking about folks who don't know LGBTQ people and opening hearts and minds, coming into your personal living, at that time it was like on TVs, you didn't have phones, coming into your personal living room or your personal space and laughing with you and crying with you. There's nothing that replaces that to move hearts and minds and to humanize people. And it's quite frankly, we're running 3 ad campaigns right now. And because we understand that only 30% of Americans know someone who's trans. So the rest of the 70% of people in America are learning about transgender people through media. Wow. And right now it's all those bad bills. So we have this Here We Are Now campaign. We have Protect This Kid campaign. We have all these media campaigns that we're running to introduce people in America to trans folks and humanize them. So it works. I think it works really efficiently and effectively to open hearts and minds.
Well, it's interesting you say that because Tim and I were talking before we got started, and I certainly have members of my extended family. I have really good friends that are members of the LGBTQ community, and it it's an education, but it's also, you know, they're living and loving life just like everybody else. And so it's just it's for me, it's been a big education. But I just think, yeah, and I do wonder how that impacts certainly the world more broadly, that if you have that experience, you just, I don't know, you're more accepting versus maybe if you don't. I don't know.
Well, Sarah Kate, that actually brings up a good point, and it's the idea that we're not talking about a monolith here. And I'm wondering if what we're seeing right now in terms of what we were describing earlier with the path to progress not being linear, are we seeing more resistance to the trans part of LGBTQ right now than the lesbian and gay part of it?
I would say categorically yes, and that's because 90% of Americans say they know someone who's lesbian or gay. And only 30%, as I said, more Americans report seeing a ghost than knowing a trans person. And so what you don't know, you
Wait,
hear.
say that again, because that's cray-cray. Say that again.
30% of Americans say they know someone who's trans. More Americans say they've seen a ghost than know a trans person.
I'm sorry for making you do that. It's just sometimes we need to hear that.
No,
continue.
I don't think you believe in ghosts,
it's
Carol.
enlightening, right?
Yeah.
It is. It's enlightening. It is. And so I do think that because people don't know trans people, that they are being targeted, and they're definitely being targeted by politicians. Most of those 500 anti-LGBTQ bills that you spoke of earlier are targeting the trans community. And for no good reason. Trans people have always been here. They have gained, and this is a little bit of what you were asking about too, they have gained more visibility than ever before, the trans community. And with that visibility comes fear, because people don't know who they are. They're trying to understand. But once you know someone, it's really, once you know someone's story, once you meet somebody, it's really hard to hate them.
How do you think about the investment universe, our world, that we talk about so much? Money can bring attention to something, can move the needles on things. The investing world can too. So I'm curious how you think about that, if there's something to connect there or not.
Well, you know, I think about our disposable income, right? As a community is, I think, 1.1 trillion. And I think about companies understand, you know, a lot of times it used to be called the pink dollar. I think companies understand that there is a lot of opportunity with the LGBTQ community on every level, in investment, in consumer goods, in all of it. And so I think that helps our community along the way, because from early on, our community has been positioned mainly because the people at the forefront of our community that had their platforms were gay white men, and they could oftentimes hide who they were in the workplace and rise into great positions that enabled them to have quite a bit of income. And that has been very helpful for our community in building our economic power and political power.
Sarah Kate, we only have about 20 seconds left, 30 seconds. What's the conversation you and I are having with Carol 5 years from now?
I think we're going to see a great acceptance. We're going to see 70% of Americans know someone who's trans versus 30%. And we're going to have a more accepting, kinder society. I know we have to get there. And I know that we're in a little bit of a culture war now, but I think on the other side of it, we're all about moving forward, building, dreaming, and that is about tomorrow.
You know, it's funny.
Love that.
I didn't hear people introduce themselves with pronouns until I went to my little brother's college graduation to show, and I'm 40.
Yeah.
It wasn't done when I was in college.
Yeah.
Like, things have changed quickly.
Yeah, there's been a lot that has actually happened, I feel like, in the last couple of years. You left us with some hope heading into the weekend, and I really, really appreciate that. I think our audience does too. Sarah Kate, thank you so much. Really appreciate it. Sarah Kate Ellis, she's President and Chief Executive Officer of GLAAD, joining us here in New York City. Yeah, I love that, right? Change does happen. Right? right? And if you think about it, right, the pronouns was a great example of, right, we weren't talking about it.
Wasn't even on our radar. Wasn't even on my radar, I should say.
All right, everybody, you are listening and watching Bloomberg Business Week, and this is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Alphabet will have to defend itself at trial against all of the Justice Department's claims of a Google monopoly in online advertising technology after a federal judge rejected the tech giant's request to decide the case ahead of time. A federal judge in Alexandria, Virginia, said this will go to trial as expected in September because there are way too many facts in dispute. Google had sought a summary judgment in the case, asking that it be decided before a trial. Oakland-based PG&E, which provides electricity in northern and southern and central California, has been meeting with investors here in New York. The demand for artificial intelligence, data centers, and electric vehicles is driving demand for power. Patty Poppe is the CEO of PG&E, and she spoke this morning with Bloomberg Television.
Our grid today is underutilized. We actually, the utilization factor of the grid today is about 45%. We see that growing to 60, 70, 80% even. And so imagine more fully utilizing existing assets lowers the unit cost. That's what happens in every other business but energy. We've built the grid big. We built it big decades ago. Now we get to utilize it and make it smarter. So with modern computing, we can actually optimize how we utilize resources on the grid and use them more efficiently.
Patty Poppe of PG&E today, the utility shares declined down by about 0.7%. Tesla makes it official. It is shifting its incorporation to the state of Texas from Delaware. This according to paperwork filed today with the Texas Secretary of State. Tesla shares declined by 2.4%. Those are our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. Let's get a check on the latest world and national news with Nancy Lyons in the Bloomberg 99.1 Newsroom in Washington, D.C. Hey, Nancy.
Hey, Tim. President Vladimir Putin today for Russia says he would order a ceasefire and or peace talks if Ukraine dropped its NATO ambitions and withdrew its forces from 4 Ukrainian regions claimed by Moscow. Defense Secretary Lloyd Austin says it's not Putin's place to dictate terms.
Putin can end this war today. You know, he started this war with no provocation. He's lost, he's had some, hundreds of thousands of troops wounded and killed.
Austin spoke from NATO headquarters. Kate, the Princess of Wales, says she is, quote, making good progress in her treatment for cancer. She says she's still undergoing chemotherapy and that she has a few more months of treatment remaining. She is expected, though, to attend a military parade tomorrow to mark King Charles III's birthday. The Supreme Court is reversing a federal ban on bump stocks. The court ruled today that the firearm accessory that allows semi-automatic rifles to fire more quickly cannot be included in a 1934 law banning machine guns. Bloomberg's Irv Chapman has background on the case.
During the oral argument, Justice Ketanji Brown Jackson questioned the lawyer in the case, Jonathan Mitchell.
Congress was trying to capture a class of weapons in which a trigger is used once, firing many times.
A single discharge of the trigger produces only one shot. The only way you get to repeated shots is for the shooter himself to continually undertake manual action.
By a 6-3 majority, the court agreed with Mitchell, deciding that a bump stock is no different from a shooter with a lightning-fast trigger finger. In Washington, Irv Chapman, Bloomberg Radio.
The Justice Department says Attorney General Merrick Garland will not be prosecuted for contempt of Congress after refusing to turn over audio of President Joe Biden's interview in his classified documents case. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now back to you, Tim and Carol.
All right, Nancy, thank you so much. Nancy Lyons, have a great weekend. We are getting ready to wrap up on this Friday, and we should point out that it's been an interesting week.
Yeah, even though today's session was relatively muted, on the week, we had some, you said it. We had some big moves. The S&P 500 up 1.6%. NASDAQ 100 up close to 3.5% for the week, but it wasn't all green.
No, it wasn't. If you look at the small caps that, everybody keeps, kind of looking at that, maybe most sensitive. They are most sensitive to the U.S. economic environment, so maybe some concerns there, but they were down. The Russell down about 1% for the week. You take a look, though, at a name. I'm just pulling it up because I want to go back there. Apple up 8% for the week overall.
Yeah, it's remarkable.
And then we know it's lagged.
And Abigail reminding us that the 2-day period following the first day of WWDC, so Tuesday and Wednesday, it's up 14%, best 2-day period going all the way back to the wake of the financial crisis.
And still only up 10% for the year.
Yeah, I mean,
so
underperforming the NASDAQ 100 and the S&P 500.
10-year Treasury, folks, down about 21 basis points over the week. And we know the big story certainly has to do with the CPI print. Yeah, nice calculating, huh?
Thank you, yeah.
You like how I did that?
Yeah, very, very impressed. You have to show me how you did that.
A little assist from Tim. We were kind of working the numbers in the break. Having said that, check out our weekend broadcast. We definitely get into the Apple story. A great conversation we had with Mark Gurman since Apple was so much in focus. Also, we take a look at, the Fed has a dual mandate. We take a look at the job market, what's going on. So we have a nice conversation around that. And one of my favorites of the week, that we talked with Peter S. Goodman.
Yeah, he's the author of How the World Ran Out of Everything Inside the Global Supply Chain. A fantastic conversation we had with him earlier in the week. Doug Krisner from Bloomberg Daybreak Asia joined us as well. And a nice extended chat. It's in our weekend show.
Yeah, love it. You will want, it explains so much of what's going on in the world economically as well as